by the Johannesburg Stock Exchange and by SAICA, a really wonderful partnership that has managed to get the news about this workshop all around, and we've had a very large amount of participation registered for today. So we're looking forward to working together on this workshop today. Also, there's a number of other partners involved in this workshop, so a big thank you to our partners at the IFC and at the IFRS Foundation for joining forces with us at the United Nations Sustainable Stock Exchanges Initiative to facilitate this training today. Now, I'd love to just pass over to our hosts, and we're going to start with the Johannesburg Stock Exchange. We're so lucky to have with us today Loshni Naidu, who is the Chief Sustainability Officer at JSE. Loshni, over to you to kick us off.
Thank you so much, Tiffany. Good morning and welcome, everyone. It is so wonderful to see so many people that have registered for this training, as well as joining us this morning. And the numbers keep going up. This is wonderful. So maybe just very quickly, why this is important to us at the JSE. One of the key elements of our sustainability strategy is to guide our markets on the importance of good ESG and sustainability disclosure. And therefore, we look to providing relevant tools, resources, information, developments that could support this objective. Hence why we're here this morning. So I'd like to take this opportunity to just thank Tiffany, the Sustainable Stock Exchanges, as well as their partners for hosting and facilitating this training this morning, and SAICA as well for being that perfect partner. And really, I hope you find this session useful. It provides you with the necessary guidance and insights, and it answers those burning questions I think many of us have around on IFRS S1 and S2. So thank you everyone for joining, and have a great session today. Thank you. Tiffany?
Thanks so much, Loshni, and thanks for your continued partnership with the JSE at the SSE. And another partner that's really made this possible is, as Loshni mentioned, SAICA. So we are so pleased to have with us the CEO, Patricia Stock. Thanks so much for joining us, Patricia. I know you have a busy schedule today, but thanks for making time this morning, and I'll pass over to you.
Tiffany, it's an absolute honor to be here, and good morning to the global difference makers on this call. I'm actually delighted to be part of this event that is focused on such a crucial role, especially for the accountancy profession, to enable sustainability reporting and advisory as well in our various functions. And I'm sure that as you gather today, and I hope as well that it will be evident and very clear to many that our roles have significantly evolved as accountants. Today we find that we're not just stewards of financial integrity, but also strategists. We are expected to be catalysts for change, to be operators and stewards for organizations' transformations. So we're at the great point where the conversation has definitely shifted from justifying the need for us to focus on sustainability, but now we have shifted towards how do we implement it effectively in our various organizations. So as an accountancy profession and many other professions, because in getting to the point of sustainable development and sustainable practices in our various institutions, it requires collaboration of different professions as well. But we believe that also that as an accountancy profession, we're well posed to integrate sustainability into financial decision-making and reporting. Right. And what we're seeing is that the convergence of sustainability and financial reporting is not just a trend. It is actually a necessity. We are seeing the growing trend with respect to investors and banks that they're looking to us to facilitate the movement of, capital towards more sustainable initiatives. So our profession's drive and leading role is what will actually bring about the real and the lasting change into the future. And the talk about the capital markets, it is definitely playing a crucial role in this journey because it influences, the investors' care and also ensuring that there is a drive to integrate both financial and sustainability focus in what we invest in. And that's very, very critical as well. So the success, definitely when we look into the future, will not be measured solely by just financial outcomes, but we'll also see more consistently, measures that will be be coming in will be including more and more non-financial aspects as well. And that has already started to happen. It's not just into the future. So to drive this change, what we need to reflect on, and I just thought about a couple of questions that you need to reflect on as you go through this session. And first question is, who should be placing value on environmental impact? If it's not accountants, who should be doing that, right? And who as well should define what are the key successes into the future in various organizations as they set strategies for themselves? And how can we shift capital from sustainable, from non-sustainable outcomes rather to sustainable outcomes? And the fourth element is, how should we place in value in the Africa's nature capital? For me, it's something that is very close to us. And as Africa is represented in this virtual room, it's very key that even when we talk about net zeros and when you consider all the other aspects, that we also think about the capitals that we have. South Africa, I believe that we are in a very fortunate position, you know, in terms of the maturity of non-financial reporting practices from the point of integrated reporting. And I want to emphasize that part because, you know, when we embark on this journey, that we should not lose the gains that we've had in terms of the disciplines that are already there. And I hope it encourages those that are in the call that it's not completely new, right? We are building, we are building on what was already there, but now we are shifting towards considering and advocating strongly, right, for IFRS S1 that we adopted as a baseline for sustainability reporting, however, without losing the integrated reporting disciplines. So as I close, I really you know, emphasizing that the importance of sustainable development goals can never be underestimated. It can never be overstated at all. And I would like to appreciate JSE for your collaborative partnership together with the UN SSE. We really appreciate your partnership. Really, for us with SAICA, is something that we believe that the collaboration helps us to accelerate and ensure that capacity building it's done right. So our purpose-led focus today will definitely shape our world for tomorrow. So I thank you so much for this opportunity, and I encourage everyone to really engage with the purpose, but the purpose that they will also take back and ensure that they are the drivers of change and lead the change that we are so desperately needing globally as we safeguard the future of our future generations. Thank you so much.
Well, thank you, Patricia, for that really inspiring start. And I think from both opening remarks, what we can see here is we are building on a very solid foundation here. So please do, everyone, participate in today's session, build on your knowledge and ask the questions that you might have so we can make sure, as Patricia noted, we're working towards a good future for everyone. Thanks so much, Patricia, for joining us, and Lushan for kicking us off. And I guess with that, it's up to us to start diving in and take everyone on this journey. Just so all the participants know, we do have you all on mute and your cameras off, and that's just simply because we have a large participation and we want to make sure that it's not interrupting the learning today. However, we do want to hear from you, and thank you so much to everyone who's introducing yourself in the chat. It's great to see all of you, where you're coming from, what you're working on. That's fantastic. Just as a reminder for how to use Zoom, I know some people are very familiar with it, others are less so, but the highlighted box there is really that Q&A. So just as a reminder, we are here to answer your questions. So if you have some questions, please feel free to put those in the Q&A box. As you can see, the chat box is just flying by because there's so many of you there. So we will lose the questions probably in the chat. We might not see them in time to be able to answer them. But if you put your questions in the Q&A, we have a log of all of them. Also, you can see what other participants have asked and you can upvote those. We might hold off on answering some questions if, for example, we're going to answer them at a later period of time during our training. So don't worry if we haven't answered it. We will during the training. We'll get to all of them. But maybe if you're seeing a question not being answered, don't worry about re-asking it. Rather, you might want to upvote one or wait till we get to that section of the training. And another quick housekeeping slide here, just to remind everyone about our kind of functioning today. We are together for the full morning. So we have 3.5 hours together. a lot of hours to ask your questions. So do take advantage of this time. We do give you a homework assignment at the end. That's a completely voluntary homework assignment. It's up to you whether you do it or not, but we provide that to you to continue your learning so that you have kind of a next step after we spend this time together. As I mentioned, there's live Q&A throughout the session, and I'll explain briefly in a moment who's here with us to answer those questions, but we do expect you to participate. We're going to have different ways of interacting today. We're going to use a tool called Mentimeter. We'll explain briefly how to use that. But we do recommend having kind of a second device. If you're on your computer, it'll work great. If you are using a mobile device, you might want to get close to a computer so that you can interact a little bit better with us using that Mentimeter. We'll also use polls and quizzes through Zoom throughout, and we'll make use of that Q&A and chat. Now, to reward you at the end for participating and actively participating with us in this workshop, we will give you a certificate at the end. We'll share details on how to do that at the end. We just need a brief feedback survey filled in at the end, and we'll share with you how to do that at the end of the training today. Now, who's answering all your questions today? So a brief introduction of all of our facilitators on the call today. So my name is Tiffany Grabsky, and I'm the SSE Academy Head. And I'm very thrilled to be joined today with Lois Guthrie, who is our Senior Specialist. And previously, Lois was a Senior Technical Advisor to the IFRS Foundation and the ISSB. And Lois has extensive experience in the sustainability reporting space, including through CDP and CDSB, as well as through integrated reporting and the World Business Council for Sustainable Development. So a wealth of knowledge there with Lois. And we also have a number of people joining us from the IFRS Foundation. So the facilitation of the training today will be together with Jarlath Malloy, who's Director of Strategic Affairs and also has, a wealth of experience in public, private, and nonprofit sectors on a range of ESG topics. And we're also joined today with two lovely colleagues from the technical team. So we have Tim Kasim, who's technical staff, as well as Laura Girela, who's a technical specialist. Thanks so much, Tim and Laura, for joining us today. Also, Laura is a specialist in integrated reporting, and so she's going to cover some extra slides today on integrated reporting to make sure that you are building on the experience that you all have here, as Patricia noted at the beginning. And also so pleased to have with us some more experts on the call. We have actually a board member joining us today. So an ISSB member, maybe you know her, she's homegrown. Nadidi is going to be, if she hasn't already, she's going to be joining us today, and she's going to be providing some closing comments today as well. And we also have with us Bella Chang from the capacity building team, who's seconded to the IFRS Foundation. Bella has been working with us on this training for some time and is also going to be helping answering all of your questions in the Q&A. So as a reminder, make use of that Q&A function. However, if your question is not answered immediately, it's because we're going to come to it in the training. So don't worry, we will answer it, but just at the appropriate time. Finally, but not least, we have with us from the IFC, Relitsa Germanova, who is an ESG officer and leads the Beyond the Balance Sheet program. She's going to tell us a little bit about that. Actually, Relitsa, since you're not going to be here at the very end, do you want to just briefly share a bit the resource Beyond the Balance Sheet so everybody has a bit of details on that?
Yes, thank you very much, Tiffany, and it's a pleasure to be here with you online. And South Africa is a market that is very close to our heart, and IFC, who has a presence in 145 countries, has been working with the Johannesburg Stock Exchange, supporting their journey on sustainability and climate disclosure. IFC, who is the largest development financial institution in emerging market, is supporting companies, regulators, stock exchanges on their ESG journey. And we have been working and developing materials, particularly for emerging markets, on those topics. One of those is the online platform Beyond the Balance Sheet that we have, and we'll share with you, where we have toolkits and a plethora of resources to help you align with the new standards and help you demystify what is behind the words and the requirements. So feel free to access them, and also to contact our offices, local offices, which can provide additional support. And it's a pleasure collaborating with the IFRS Foundation and our friends in the UN Sustainable Stock Exchanges Initiative to build capacity around the world on those new topics where we see so much demand. And my next call is with Pakistan Securities and Exchange Commission, working exactly on those topics and aligning. So we see a huge demand around the world, so you're not alone on that journey. Thank you, Tiffany.
Thanks so much, Ralitza. And if you want to share in the chat too, a few of those links, that'd be helpful. Just to let everyone know, at the end of the session, we'll also share with you those links again. And this is in your handout. So Lois has been sharing in the chat box how you can get these slides. They're all on our website. And we have details about all the tools we're sharing today too in that slide handout. Great. So we have a few learning objectives together today. Just to briefly cover those, we have 3 core learning objectives we want to achieve today. And the first is quite simply to understand the ISSB standards, or the IFRS S1 and S2. Let's hope that we all leave with a clear understanding of what they are. But also our second objective is to understand how to use the ISSB standards. So we're hoping that you all leave here not only with an understanding of what they are, what the standards are, but also how you can make use of them and how they can be most effectively used, especially when you already have a great foundation of integrated reporting. But then finally, we have a third learning objective, and that's to help you to identify what steps can then be taken to develop a disclosure plan. Now, a disclosure plan is not required by the IFRS sustainability standards. However, we present it today in our training as a tool that you can use to kind of take your next steps and make sure that you're continually enhancing your disclosure. So that's actually your homework assignment today, but we'll walk through it throughout the training, and hopefully by the end, you know kind of what initial steps you can take to enhance your disclosure plan internally. Now, in order to achieve those 3 objectives, we have broken our training down today into 4 modules. So here's a brief overview of those 4 modules we're going to be covering today in our 3.5 hours together. The first module is really kind of setting the basis. So it's our prepare module. Here we'll discuss the case for and the purpose of sustainability reporting, and we'll also discuss how the landscape has evolved and how the ISSB has come to be. We're aware that, we do have quite a few of you on the call that are quite familiar with this, so we won't dwell too much on that module, but just to make sure that you all have that great solid foundation to start off with. Then we'll dive into module 2, which is our align module. And here we see align as really kind of those railroad tracks keeping us in the right direction. But before you set the railroad tracks, you need to know where you're going. So really seeing what the objective is and how we can make sure we're staying on track, and how we can use the ISSB standards to do so. Then we'll also in that unit look at any additional disclosure that you might want to include. You might have heard the building block approach to the IFRS sustainability standards. So we'll discuss that in a little bit more detail. Then we'll move into a little bit more of the nitty-gritty, I'd say, in our module 3 of implement, where we're going to look at how you can start identifying, evaluating, and integrating sustainability-related and climate-related risks and opportunities. And then our final unit will look at the communication, the final output. How do you effectively, efficiently, and with a lot of trust in the market, put out your communications on sustainability-related topics? So to do that, here's a brief overview of our agenda. I think what I'll highlight here is we do have a short break in the middle. It's just a quick stretch break, 5 minutes, to give you a moment to maybe grab a coffee or a tea, stretch, refresh a bit, and then we'll dive back in. We do have a lot of content to cover today, but just so all of you know, we are recording this. So sometimes maybe if something's a little bit heavy or there's a lot of content, don't worry, you can come back to it and we'll share that recording at the end so that you can use that as a resource. And of course, you also have the slide deck as well as a resource. So as I guess I had already led to in the previous slide, the training materials is already on the website. So you can find the slide deck and you can find your homework pack already on our website, and Lois has been sharing that in the chat. We also will discuss the homework throughout, but that homework assignment is to develop a draft disclosure plan for your organization. And what it's really meant to do is get you started to move after this workshop. The idea isn't just to listen and then forget, but rather to start putting this into action. So today we're really working with you to help you understand how you can use these standards and the utility of them, especially today together with integrated reporting. And then as you leave today, we want you to start thinking about how you're going to put that into practice. And a disclosure plan is a great way to just start that moving forward. So we'll do a few activities today to get you started. And then hopefully after the session, you'll sit down and take some time and start to think about that. We also have a number of tools available to you. As I mentioned, we'll share them throughout the training, but you can access it with this QR code or the links we're sharing in the chat. We have training tools, which are kind of short publications, which just give you a bunch of resources to get you started. We have that on transition plans and on disclosure climate or disclosing climate related metrics. We also have a gap analysis checklist, which is a very simplified checklist that can help you get started to analyze any gaps in your current disclosure. And we also have on the far left-hand side there, the model guidance, which has a lot of the content of this training in it. It's meant for stock exchanges to guide their markets, but you can also make use of that as it has a number of great resources in that for you. Now, I did say we were going to interact with you. So here's our first Mentimeter we're going to do together. So hopefully we can figure this out together. We have a lot of you on the call, so we hope to see a lot of you in the Mentimeter. You can access this a few different ways. So one way is to use that QR code in the corner of your screen now. You can just use your phone pointed at that QR code, and it should pop up in a browser on your phone with that question. In 3 words, tell us why you joined today's training. Now, you might not have a phone, or you might not be comfortable using the QR code there. So you can just open a browser on your computer or on your phone and type in www.menti.com, and then it'll ask you for a code. And that code you can type in is 6856-3622, as you can see on the top of your screen there. And the final way is simply clicking that link in the chat. Lois is sharing a link with you, and that will bring you directly to this page. Now, the good thing is once you're in, you're in. So we will change the slides throughout as we ask you new questions. You can just come back to that same browser that you had open, and the new question will appear. So I see we already have more than 100 people participating. So I think you're managing to enter it okay. We'll let you continue to fill this in, but I see the number one word here is knowledge, learning, understanding, learn. But I see also change is a very clear word that I've been seeing pop up. So that's very interesting. We're seeing a lot of maybe shift in how we're reporting in the region. But the key ones are still understanding and knowledge and learn. Somebody is very keen for, a few people are keen for their CPD certificate. So hang on till the end and we'll make sure you get that. So great to see everyone participating there. A lot of great words now. Now, we want to also get a sense of how comfortable you are with the IFRS S1 and S2. So a few questions for you. So these questions ask you your comfort level. You can say strongly disagree if you're not comfortable at all, or strongly agree if you're very comfortable, or somewhere in between. So how comfortable are you with explaining to team members what the ISSB is, or maybe what the IFRS S1 and S2 are? We'd also like to know how comfortable are you with using the ISSB standards? And then finally, how comfortable are you with developing a sustainability reporting strategy? Now, it looks like So far, at least of the nearly 200 of you that filled in were low on the comfort level. So you're here for a lot of confidence boosting to build that knowledge and understanding, which is great because that's what we're here for. But there are a few of you who've kind of said you're very comfortable with a few of these. So those of you who are very comfortable already, please feel free to share your experience in the chat. We'd love to hear from you. And those who are very uncomfortable with these topics, let us know if there's any questions along the way that we can help you to further build that confidence level. So I think that's really great. It's good to see that we have everybody, in various levels of knowledge here. And I think this is great because we're quite ready for that. That's what this training is made for. So I'm going to come back to our deck here and we're going to dive straight into the content, just starting with a quick disclaimer. As you can see with the disclaimer on the screen here, that this is really referring to the examples that we're using. The examples here are really just to add color to what we're doing. So this is not any example, any company we highlight here, any report that we include in our training is not an endorsement of this is especially how you should be doing it or how everyone should be doing it, or that the IFRS is saying this is the only way to do it. It's rather just to add a bit of color to all the conversation today. So you might want to use some of these examples to, bring up some ideas in your organization or give you a bit of new thoughts of how to move forward. But keep in mind that every company does this how best suits their organization. So copy and paste doesn't really work here, and none of the examples are necessarily being endorsed by any of the organizations in this training. Now, to kick us off today, just to know our first module in Prepare, as I said, we know that a lot of you actually are well understand sustainability and ESG disclosure, so we won't dwell on it too much, but we did want to give you an idea of kind of the purpose of sustainability disclosures, the landscape, and the global baseline. And I'm going to start now with the purpose, so the case for and market drivers for sustainability reporting. And to do that, I'm going to kick us off first with a poll. So on our first poll here, and this should just pop up on your screen. If you are on a mobile device, you might have to swipe to another screen to see the poll. And it asks, what are your reasons for disclosing sustainability related information? Is it due to regulatory requirements? Is it because you want to share management's objectives? Is it because of peer pressure, maybe social expectations, either from your clients or from other organizations, your peers? Is it due to investor interest? It might be other reasons, and we'd love it if you shared that in the chat. And it might be that you're not disclosing any sustainability related information yet, and we'd love to hear if that's the case as well. So I'll give you just a few minutes, maybe 30 seconds. We've already had nearly 400 people fill it in, so we'll close 10 seconds. I see in the chat somebody is disclosing information due to bonds. So they're issuing a sustainability linked bond, which then requires, of course, disclosing information. Another one says group requirements abroad. So they're connected to another jurisdiction. So let's see the results here. A close tie between regulatory requirements and investor interest, which is very common answers we see. What I also see here is that a third of you mentioned that you're sharing management's objectives, which is a really great answer. And we hope that many of you get to the point where it might not only be because of regulatory requirements or investor demand or investor interest, but also because you want to share your management's objectives and you want to make sure that it's being well known what you are doing internally to make sure that you're mitigating and adapting to climate and sustainability related risks and opportunities. So great, we'll end that poll and I'll continue on here. So some of you said investor interest. It was one of the tied top areas here. And you might be familiar with the UN supported principles for responsible investment. And as you can see here, there is a lot of investor interest now in ESG and in sustainability principles. So here you can see that there's more than 5,000 signatories globally of the PRI, and they represent now more than 121 trillion US dollars in assets under management. And these are investors that are investing using the signatories of these principles. But what I think is interesting to highlight is what is driving this interest in the investor community? Why do they want to know, particularly the sustainability related information? So just a quick study, there's many out there, but just to flag this one study that was done by Morgan Stanley, and they studied in particular retail investors. And what they were looking at is why investors were investing in sustainable companies and looking for sustainable investments. But what I think is most interesting here is that top one, the number one reason, 74% of investors were investing in sustainable investment were investing because of the financial performance. So it wasn't philanthropy. It wasn't because they thought, they would do well for the community. It was because they knew there was a financial impact here, and they wanted to have that information to be able to assess the financial effects. So we are going to be talking a lot about financial effects. Sorry, I moved a bit too fast here. We are going to be talking a lot about financial effects today. But in your slide deck, there's a little bit more. We're aware that in South Africa, it's something that's quite well known, having had the King Code for quite some time now and corporate governance being around for quite some time. But if you are maybe a bit less familiar with what financial effects might be found within a company as a result of sustainability and climate-related risks and opportunities, do go to your handout and use an extra couple slides here that discuss that in more detail. But in the meantime, just to move forward on this discussion, I want to just flag two kind of key areas about risks. So we will talk a lot about risks. We can't forget about the opportunities. I'd say they're as or more important than the risks often are. But when we're talking about risks, and particularly sustainability and climate-related risks, I think it's important to note the time element. So as you can see here, this is from the World Economic Forum's Global Risk Report, their latest report for 2024. And as you can see, when we're looking at risk perception 2 years out, there's various different risks we're looking at. So the top one is misinformation and disinformation. And we do have one climate risk at the top, extreme weather events. But then most of them are kind of diverse types of risk: geopolitical, economic, social, technological, etc. But then if we go a bit further in time, 10 years down the line, the perception of risk congregates at the top to environmental. So I think it's really important to remember that a lot of the things we're talking about, especially when we talk today about S2, which focuses on climate, we need to take into account that we're looking at time horizons that maybe we haven't been so focused on previously, and that requires a little bit of a different type of accounting and a different type of managerial response, especially when a lot of these risks require investment today if we're going to make sure that we're prepared for that risk in the future, because it's not something necessarily that we can react on a dime and just turn our strategy overnight. Another important aspect about risks is the connections between these risks. So I had already mentioned in the last slide S2, which we'll dive into later, but S2 is more for climate disclosures, whereas S1 is looking at general sustainability disclosures. And one of the most common misconceptions we find about these two standards is that people think they're two separate standards. But as you can see here, climate and other sustainability risks are not separate. They're actually very much connected. And in the same way, our reporting needs to reflect those connections as well. We're going to talk about all sorts of connections today, but just to highlight that connections between risks are indeed there. They're present. This is also from the same report, but just to keep in mind that the same thing in our reporting, we want to make sure that we understand all of our, climate risks connected with social risks and other socioeconomical risks that we're talking about. And the same goes for opportunities. So with that brief introduction, I'm going to pass now over to my colleague Lois, who's going to take you through the next section, the landscape. Over to you, Lois.
Thank you very much, Tiffany, and hello, everybody. So Tiffany's taken through the reasons why sustainability reporting has evolved, and in this section, we're going to look at how. First of all, though, let's do another poll. And this poll is just to establish what types of frameworks you're currently using, if any, for sustainability reporting. So are you using CDP, the Carbon Disclosure Project, GRI, the Global Reporting Initiative, the Integrated Reporting Framework, the Sustainability Accounting Standards Board standards, the Climate Related Financial Disclosures Board, or the UN Global Compact? Oh, and somebody's written in the chat they're using TNFD, the Task Force on Nature-Related Financial Disclosures. And we also have people saying the CSRD, the Corporate Sustainability Reporting Directive in Europe. Lots of participation today, which is lovely to see. Perhaps quite a poll result we could expect in South Africa today. Or we've also seen the King Code quoted, the Australian greenhouse gas ENGA, as they call it. I'm going to end the poll here. Thank you for all your input and share the results. And I don't think you'll be surprised to see that integrated reporting is the framework used by 75% of those of you that have participated. And then there's a fairly even split there between TCFD and GRI, but some of the other frameworks are being used too, as well as the ones that you've raised in the chat, including TNFD, the King Code, the Johannesburg Stock Exchange Sustainability Disclosure Guidance. So thank you very much for sharing all of that. And we'll move on to look at the evolution of reporting standards. So this slide shows the logos of just some of the organizations that have helped to develop sustainability reporting over the years. Now, what the logos here have in common is that the organizations represented focus primarily on meeting the information needs, the sustainability information needs of investors. So all of these organisations have contributed to the evolution of sustainability reporting, and in fact they have quite a lot in common, but the range of objectives, guidelines and standards on offer did cause some confusion in the market that people sometimes called the alphabet soup. A number of these leading reporting initiatives have now been consolidated into the IFRS Foundation to form the basis of IFRS sustainability disclosure standards that we're going to look at today. So if we look at the bottom middle section logos, we see that the Climate Disclosure Standards Board, the Integrated Reporting Framework and the SASB standards have been consolidated into the IFRS Foundation to help form the basis for the standards we're going to talk about today. On the left-hand side of the screen, the TCFD has actually its work has culminated and its recommendations have been adopted into the IFRS standards. So TCFD's now been disbanded, but its work continues. On the right-hand side, CDP announced in June that its climate questionnaire aligns with IFRS 2 standard on climate disclosure requirements. So really, in a nutshell, what this slide shows us is a picture of harmonization and a picture of simplification. And there's actually more harmonization that's going on, and we'll look at that when we come to talk about transition plans later. So now let's do another Zoom poll about the TCFD. So if you have been, or anyone you know has been using the TCFD recommendations, does that mean that compliance with the TCFD recommendations automatically means compliance with the ISSB standards? Is this true or false? I can see that we've got nearly, yes, we've got over 50% participation now, and there's a clear pattern emerging. So I'm going to end the poll and show you the results. 81% of you are quite right. It is false. If you conform with the TCFD recommendations, you cannot automatically assume that you comply with the ISSB standards. Now, the congratulations to everybody here, because we have asked this question to other groups who were not aware of the small but noticeable differences between ISSB S2 and the TCFD recommendations. So well done. You're one of the only groups I think we've worked with that has very clearly got this question right. So let's move on to look at these differences between the TCFD and the ISSB. So although the TCFD's work has been incorporated into IFRS S2, there are some differences between the two, and they are explored in the document that you can see on the left-hand side, and we'll provide you with the link to that document as well. And all the document tells you is that in some cases, the differences between the two are just that they use different wording, but actually to capture the same type of information. In some cases, S2 requires more detailed information than TCFD. And an example might be that there's more detailed information required about carbon offsets or use of carbon offsets. And also IFRS S2 has some additional requirements and guidance that weren't in the TCFD, and most noticeably that is the requirement to consider the industry specific guidance that goes with the standards. So let's go on to look at the structure of the IFRS Foundation. What is it? Those of you that are accountants on the line will know it very well, but the IFRS Foundation is a not-for-profit public interest organisation that was established to develop high-quality, understandable, enforceable and globally accepted accounting standards, and now also sustainability standards. So at the bottom of the slide, you can see that the IFRS Foundation hosts two independent standard setting boards. The International Accounting Standards Board was formed in 2001, and the standards set by the IASB are in place in over 140 jurisdictions around the world. And now we have the International Sustainability Standards Board, the ISSB, that was formed in 2021 and released its first standards in 2023, following the strong market demand for its establishment. The governance of these bodies, these standard setters, is provided by trustees, and they are in turn accountable to a monitoring board of public authorities. And the last thing to say about this slide is that the IASB and the ISSB work very closely together to ensure that their standards complement each other. So one of the objectives of the ISSB is that it sets a global baseline for sustainability information. Now, what does this mean? Well, the baseline is designed to enable comparable and consistent sustainability disclosures across capital markets. The Foundation works with jurisdictions around the world through its jurisdiction working group and other channels, as well as other stakeholders, to achieve this. So regulators and exchanges are able to require companies to disclose further information in addition to what the ISSB standard requirements say by adding their own building blocks to the global baseline. Now, these additional disclosures can be required or requested or encouraged by jurisdictions and others, but provided that the additional information is presented in such a way that it does not obscure the information required by the ISSB standards. So what this could look like in practice is that the building blocks could say that in addition to the information required by the ISSB standards, companies should provide information for multi-stakeholders or something that is very specific to the jurisdiction in which they are operating. So taking this building block approach reduces the need to duplicate information because you've got that globally consistent baseline of disclosures, but it also adds jurisdictions and others to add requirements. Now, with this global baseline, there has been global backing for it. It started the baseline with the publication of the ISSB standards, but in July 2023, the International Organization of Securities Commissioners announced its endorsement of the ISSB standards. And in fact, IOSCO asked their 130 members to consider how they could incorporate ISSB standards into their regulatory frameworks. We have the development of audit standards to support sustainability disclosure assurance in development. As I said before, jurisdictions are working with ISSB and within their own jurisdiction to consider how they will adopt the standards and what that will look like in particular jurisdictions. And of course, in the meantime, the ISSB and others are working with market participants so that they can voluntarily opt to apply the standards, and this program and the ISSB's capacity building program supports that. And I'm going to hand over to Jarlath to take us through the next section.
Thanks, Lois. Sorry, just get my IT working. We've talked about the business case and the market case for sustainability reporting, and the evolution of the landscape and how it's been simplified and rationalized. Next, we're going to introduce ourselves to an overview. Next, we're going to introduce ourselves to S1 and S2, and we'll start with an overview before we then get into more of the detail. As we start, it's important to take a moment and think about some of the terminology we'll see in today's session. There are some key terms that should be understood, and you can find the definitions in the handout. But I did want to flag a few important things before we get into the detail. So firstly, we will see phrases like sustainability-related financial information and sustainability-related risks and opportunities quite a lot in today's session. And by this, we're really referring to a broad range of issues. And these include, for example, climate change, nature, biodiversity, social aspects, and so on. Sustainability-related financial information is information about a company's sustainability-related risks and opportunities that's useful to primary users of what we call general purpose financial reports in making decisions about providing resources to that company. And sustainability-related risks and opportunities are those that could reasonably be expected to affect the company's cash flows, access to finance, or costs of capital in the short, the medium, or the long term. We'll also refer to something called general purpose financial reports, which includes a company's general financial statements and sustainability-related financial disclosures. And finally, management commentary or a similar report may be known as or include reports with various names, which you might know by as a management report, a management discussion, operating financial review, or integrated or strategic report. So these are all these are all terms used in different jurisdictions. I also should add, sorry, I've noticed a few hands in hands being raised by participants. If you have any questions, please just drop them into the Q&A session, into the Q&A panel, and we'll cover that as we go along. And of course, if there's lots of questions, you're able to upvote or like individual questions, and the popular ones will rise to the top. So let's get started with the overall structure of the standards. So anyone who's familiar with TCFD will recognize the same 4 core pillars or content areas for the ISSB standards. And these are, as many of you will know, governance, strategy, risk management, and metrics and targets. And for each of the content areas, there are a key set of disclosures to be addressed. And the standards provide very detailed guidance on each of these individual requirements. Now, we'll discuss each of the 4 areas today in this session, but of course, it's not a substitute for actually downloading the standards yourself and reading them in your own time as part, for example, as part of your homework assignment. What I might do is start by saying to all of the sustainability preparers listening, don't be afraid. Yes, of course, there's a lot to get your head around. There's a lot to understand, but you might be surprised. Some of the detail you'll see here isn't really that unfamiliar to what you know already. And also for any of the accountants with us today, you'll be relieved to see many of the same conceptual foundations developed by the IASB, the accounting board, have been incorporated in the ISSB standards. So with that said, let's begin to go through the standards. So the first one is IFRS S1, or to give it its full title, General Requirements. And that's something we'll come back to. General requirements for disclosure of sustainability-related financial information. And the slide here really just sets out some of the key concepts in S1, and we'll go through that today. S1 sets out general requirements for the content and for the presentation of sustainability-related risks and opportunities. And as I said, if you're familiar already with TCFD, you'll see the same architecture applied throughout the standards. And S1 asks preparers to refer to also and consider the applicability of the SASB standards and other sources of further guidance to identify these sustainability-related risks and opportunities and help identify what's material for your company. The SASB standards are organized by industry, and that helps companies identify sustainability-related disclosure topics and metrics that are applicable to its business model and operations. And finally, the standards can be used with any accounting requirements. Now, whereas the scope of S1 is all sustainability topics, except for climate, which is instead covered by S2. And S2 focuses on climate disclosures, building on the same foundations as S1. So, for example, it fully incorporates the recommendations of TCFD, and we'll come back to this. Lois already mentioned it. It sets out the requirements for a company to disclose material information about its climate-related risks and opportunities, and it requires disclosure of both cross-industry and industry-specific information. You'll see in terms of climate risk, this includes both physical climate risks and transition climate risk, and we'll come back to this a little bit later. There's a number of other specific climate-related disclosures which are required in S2. So, for example, and we'll come back to this, don't worry. For example, on scenario analysis and on greenhouse gas emission disclosures. We asked the S2 asks that preparers also refer to and consider the applicability of industry-based guidance when implementing S2. And this is organized by industry, allowing, again, like with S1, a company to identify topics and metrics that apply to its business model and its operations. Now, a question we often get is, can I use S1 or S2 on its own? And the simple answer is no. They are not standalone individual standards. It's not like a menu you choose from one or the other. They're designed as a package, and they have to be applied together. Even if a company is only reporting the climate-related risks and opportunities, it must apply S1. And that's because S1 sets out the parameters for the type of information that needs to be provided in order to be decision useful for investors. And so, for example, the fair presentation requirements require disclosure of relevant information about sustainability-related risks and opportunities, while the faithful representation requirements require a complete and neutral and accurate description of those risks and opportunities. And S1 also explains the concept of materiality and how companies identify this information. One way to think about it is that S1 and S2 are about 45 pages long each. S1 talks about general requirements, so it's quite broad, and it doesn't go into too much detail on anything in any specific topic, whereas S2 is the same length in 45 pages, but it goes right down into the detail on climate-related issues. So S1 is broad and S2 is right down into the detail. So in addition to the terminology that we talked about a couple of minutes ago, I also want to pause here briefly and mention some conceptual foundations that underpin the ISSB standards. And these conceptual foundations help to understand how best to disclose information in order to meet the requirements of the standards. And this really is probably most relevant to anyone on the call, say, who doesn't have that accounting background. So, for example, to start with, one of these conceptual foundations is the requirement for a company to fairly present a complete set of sustainability-related risks and opportunities. And fair presentation requires disclosure of relevant information, and then faithfully represented in the accounts. To achieve faithful representation, companies must provide a complete and a neutral and an accurate description of these sustainability-related risks and opportunities. The reporting entity conceptual foundation under IFRS S1 requires the reporting entity for sustainability-related financial disclosures to be the same as it is for financial statements. And another important concept is connected information. And we saw earlier, Tiffany showed that example of the connections between the risks and how they're often interconnected. The standards require companies to clearly identify key connections. And so, for example, those between risks and opportunities, those between the 4 core content areas that we talked about already, and of course, the connections between the sustainability-related financial disclosures and the main financial statements in the other part of your report. And Lois is going to take us through an example next.
Yes, thank you, Charlotte. This is our first example of the training session, so please do remember the disclaimer that Tiffany took us through earlier, that these are simply examples to inspire you. We in no way present these as representing our best or good practice. They are simply to illustrate some of the things that we're talking about. So this first example is from a company called BHP, which is a big mining company based in Australia with operations elsewhere. And in this example, what we're looking at is the way in which the company connect various pieces of information and various things. Now, often the things that we're asking to be connected, some of them at least already exist in the organization. The first thing we want to talk about in this example is the fact that BHP already has an investment process and decision-making process. And what they're telling us in the first paragraph is that they link their decarbonisation strategy with that investment process. So they say all investment decisions consider the quantity of greenhouse gas emissions associated with the project, the cost per tonne of CO2 equivalent associated with the project, and the alignment with the group pathways to a net zero trajectory. So what we see there then first is that investment decisions, investment process is connected with the decarbonisation strategy, which is set out in the group pathways to a net zero trajectory. The second thing we can look at in this example is that the decarbonisation strategy is connected with various types of expenditure the company makes now and anticipates in the future. So you can see how much was spent on operational GHG emissions reductions in the reporting year, and that was US dollars 122 million. And you can see what the company anticipates spending, which is US dollars 4 billion from the financial year 2024 to the financial year 2030. So the second connection we see then is between the decarbonisation strategy and current and future expenditure. Thirdly, we see the connection between the decarbonisation projects and the net present value. So based on their current assumptions, the achievement of the medium-term targets is expected to deliver a positive net present value for the group. This is in the penultimate paragraph here. And to date, most implemented projects have delivered a positive or neutral net present value. So that's the third type of connection. The last thing I'll point out in this slide, because it's relevant to things we'll discuss later, is that this lovely orange logo at the bottom tells us where we can find more information in the report about what's being said here. So they're connecting to other parts of the report. And I'll hand back to you, Jonathan.
Thanks, Lois. Sorry, I'm just watching the Q&A panel here. There's some really good questions coming in, and I also have seen a couple more hands being raised. And just to remind everyone, if you've got a question, please drop it in the Q&A panel, and we're doing our best to keep up. And you can use the chat panel for anything else. So thanks, Lois, for that example. On materiality then, we'll cover this in a little bit more detail later on, but I wanted to just briefly mention it here. The standards are built on the foundations concept of materiality, which we've defined for a long time through the Accounting Standards Board. And really just to highlight this in summary, when we're talking about materiality, we're referring to material information, which is information that influences the investment decisions of the primary users of general purpose financial reports, which for the most part is investors. And as I said, we'll come back to that a little bit later. So we're on to the next Zoom poll. And sorry, a second. Thank you. The question is, what information should be considered for connectivity? And this comes back to the conceptual foundations we were talking about just before Lois's example. So what information should be considered for connectivity? And it's multiple choice. So your options are connections between governance, strategy, risk management, and metrics and targets, sustainability-related financial disclosures, and financial statements. And finally, option 3 is sustainability-related risks and opportunities. So what information should be considered for connectivity? And it's a multiple choice. Just give it another couple of moments. Let's call it there. And so all answers are correct. So well done to everybody who selected all 3. And if you didn't quite get that right, don't worry. There's more information in the handout, and you can get a link. You'll get a link to that afterwards. So during the ISSB consultation on the exposure drafts, one of the key feedback topics was the importance of supporting preparers, and particularly those with more limited resources, and those as well in emerging and developing markets. In addition to the standards on the application guidance that was published last year, a number of educational resources were also published, and many others have since followed, including the Knowledge Hub, which we launched last December. And maybe those could drop a link to that in the chat. And we'll also refer back to this a little bit later. And we're also in the process of gathering examples and case studies provided by our partners, and they will go on the Knowledge Hub in the near future. As well, then, the SASB standards were aligned with IFRS S2 to help preparers who are seeking industry-based guidance, and also the FSA credential, which is on our website. It's a program you can undertake yourself. The FSA credential was also updated, and there's much more in the pipeline to come. And of course, I should also note that the Foundation's capacity building program is a key part of our support to preparers, and naturally the SSE training initiative is one of our most important deliverables. And we're going to move on to the next poll. The question here is, and this is coming back to the additional guidance point. Water is a vital input to your business, but the ISSB standards don't have a specific standard on water. So the question is, what do? You have 4 options here. The first option is, well, don't disclose anything about water, because there's no guidance or standards on, or there's no standard on water. The second option is consult the sources of guidance which are listed in the standards. The third option is engage a consultancy to help and support you. And the fourth option is copy your competitor, see what your competitor is doing. And it's a single choice. Okay, let's call it there. We're at 50%. So the correct answer is B, consult the sources of guidance listed in the standards. However, interestingly, C, option C, engage a consultancy, that's also quite a reasonable approach to take. And even option D could be relevant. It could be important to see what others in your sector or in your industry are doing, and help prompt you to consider whether you've got the right approach or a similar approach. So that's an interesting one to think about. And I'm going to move on then.
Charlotte, I'll take over from here.
Yeah, thanks, Stephanie.
Thanks. Actually, that brought us to the end of the first module. So just a quick summary. We are a few minutes behind, so I'm just going to summarize this really briefly. But what we really tried to get through in this first module is the importance of starting to understand the benefits of improved disclosure. And of course, those benefits can be both internally and externally experienced. We talk a lot about investor interest here. But let's also think that there's actually then unintended consequences. We actually then make our organizations more resilient and prepared for these risks and opportunities. So that's an important process that we go through. And it's why investors are so interested in understanding how organizations are dealing with these risks and opportunities. Also, remember to use the ISSB standards as a baseline and build on top of that. We looked at how various organizations or other standards and frameworks work together or have been built together into the ISSB, and we'll talk more about that in the communications section. And then I think the third point that we really talked about a lot in this first module was to be clear who your audience is, because as we had a question also in the Q&A about this, obviously we're talking a lot about investor interest here, and that's because these standards come from the IFRS, and they're really looking at how to provide information to investors. So as we're then moving and looking at the exact disclosures in our next unit, let's keep in mind, of course, when we provide different disclosures, it's important that we understand who we're communicating to and what information they actually need. Now that brings us to our first activity. We're going to do this one fairly quickly together so we can dive into the real breadth of today's training. But as a reminder, we asked you as your homework to then look at kind of how are you going to adapt your disclosure strategy? How are you going to write a disclosure strategy, maybe if you don't have one, and plan for your disclosure moving forward. And one of the first things to think about there is actually the people in your organization, the who's going to be doing this. And a few things to consider in the who aspect is the tone from the top. So making sure you're identifying who in the organization at the top level and the C-suite and the board are going to be kind of the oversight here, making sure things are moving forward and that they're appropriately aligned. Also then integration throughout, identifying what teams are already familiar with the evaluation and management of sustainability related risks and opportunities, and what teams will need additional capacity building. And then finally, negotiation. We find a lot with the standards where enhancing a lot kind of who's involved in this, and it requires a bit of negotiation, who gives what information to who, how it's collected, who manages it, that sort of thing. So it's important to start to think about those things and make sure that you have the right teams involved within your organization. And hopefully many of you have many colleagues from your same organization in this training workshop today so that everybody can kind of wrap their mind around the requirements. I'm going to go back to our Menti poll now. I've seen a few of you have already started filling this in. And this Menti poll asks you, what will you do to identify the skills and knowledge gaps in your organization to meet the ISSB standards or the IFRS S1 and S2? So that's thinking about the who here. So what skills and knowledge gaps exist in the, the people in your organization? So some of you said training and development or tertiary education. Also see attend webinars such as this one, internal awareness sessions. Those are all really good starts. Somebody says research, really do a gap analysis, a synthesis to understand the capacity within your organization. Perfect. These are all really good answers. We see training, awareness, surveys, asking questions, training and development. A lot of training development in there. I see here, call a consultant. That's also not a bad idea at the beginning, just to kind of flag what might be missing in your disclosure. We're going to talk about that a bit more in the next section, but that will also then help identify maybe where the gaps of knowledge or skills might exist within your current organization. Great. A lot of very good answers here. So I think you're all going to do very well in that first section of your homework. You're all well on your way. Oh, there's so many answers. So well done, everyone. I think with that, I'm going to go back here to our slides so that we can continue on and look at exactly what needs to be disclosed. Let's see. Great. We're back to the slides here. And I'm going to actually pass back to Jarlath, who's going to kick off this next module. So back over to you, Jarlath.
Super. Thanks, Tiffany. Sorry, just trying to get my IT working. So the next section is now that we've covered those. Sorry, I'm a bit distracted here. Now that we've introduced those initial concepts, let's dive into how to apply the standards and integrate. And this is really an important one. Integrate additional disclosures, and they could be, for example, relevant to your geography, your jurisdiction, or indeed your sector. We've got two units in this section, and I'm just, in the interest of time, I'm just going to move along a little bit. So let's begin with governance, which is the first core content area. And this includes aspects that relate to the governance body in your organization and how management is applied. For each of the four core content areas, we'll discuss a list of questions that a reporting company could use to start identifying information that supports meeting some of the disclosure requirements. So, for example, as part of a gap analysis of your current practice. And if you look at the governance section, some of the requirements, we can see that there are several that are fairly qualitative and questions that should be discussed internally, including those which relate to, for example, the role and the responsibilities and the skills and competencies of the members of governing bodies or boards or committees or whatever it's called in your own company, but ultimately that are responsible for the oversight of these sustainability related risks and opportunities. As well, then, how and where do they get the information about sustainability risks and opportunities? What sort of decisions do they make? For example, do they set targets to manage these risks and opportunities? And who is responsible for the management and the monitoring and the oversight of these risks and opportunities? And of course, you'd expect to see information around the processes and the controls that are used for managing sustainability-related risks and opportunities. And for more information, you can make use of the SSE checklist tool, but remember, it's not a replacement for reading and using the standards. And we can take a look using a couple of examples that Lois is now going to take us through.
Thank you, Jarlath. Yes, the first example is from AIB, which is an Irish high street bank. It's got a lot of sustainability credentials. And here we're looking at the way in which they make their disclosures about how they govern sustainability related matters and information. Now, as we're going to talk about later, in many cases, companies can rely on the processes and procedures they already have in their company and adapt them to or use them for making sustainability-related disclosures and supporting activities. So in this case, we can see in this governance model example, there are 3 board committees: the Board Risk Committee, the Sustainable Business Advisory Committee, and the Board Audit Committee. And each in turn is supported by an executive subcommittee and management. And this adopts the so-called 3 lines of defense model, which means that the risk is taken account of at operational level by the risk department and by internal audit. So there are this just sets out one example of the way in which the company expresses their governance of sustainability related matters and information. But of course, there are many different governance models to choose from. If we look at another example, Toyota, a car manufacturer that needs no introduction, because we're running short of time, I won't go through this in too much detail, but this is an extract from disclosures made by Toyota using the TCFD recommendations. And in this example, we see how what is the role of the board. So they tell us what the board actually does. In the just the penultimate bullet point there, we see what the board has actually done. So they've said that the governance mechanisms that they have in place are used to formulate long-term strategy, including a particular strategy they call the Toyota Environmental Challenge 2050, and to inform, formulate and review their medium to long-term targets and action plans. So we have a sense of what the board is meant to do, what they've actually done, and then finally, they tell us the actions that they've taken. So the cases of decisions they've actually made, which include decisions about the extent to which they will invest in batteries for battery cars. So that's just a brief example from Toyota. And I think I'm handing on to you now, Tiffany.
Yes, thank you, Lois. So hopefully those examples kind of help make it a little bit more clear what we meant by governance. But now let's move into strategy. And as you can see here, strategy does have quite a few more disclosures to include than governance. But it's really where companies can see those benefits from sustainability related opportunities and being prepared for those risks. And as you can see here, there are kind of 3 high-level areas that we focus on in the strategy content area, which are risks and opportunities, effects on different areas, the business model and supply chain, the strategy and the financial and cash flows, and the resilience. So let's dive into that a little bit more with that first kind of high level area with sustainability related risks and opportunities. Now, as a reminder, IFRS S1 and S2 disclosure requirements on strategy are designed to enable users of general purpose financial reports to really understand a company's strategy for managing sustainability related risks and opportunities. And if we look at that first high level requirement of the sustainability related risks and opportunities, here's a few of the questions that you might want to start asking internally to be able to build up that information for some of those disclosures. So for example, understanding exactly what risks and opportunities could reasonably be expected to affect a company's prospects that you've already identified, or as you're going through this process that you're identifying. And of course, as we identify those risks and opportunities, kind of the time horizon related to them, the short, medium, and long term, which we'll discuss a little bit more in detail later. And then for the last two questions on this list, they particularly look at climate. So this aligns with requirements from S2. So for example, investors also want to understand what types of risks and opportunities, and we often see companies using the categories that have been already identified by TCFD, so physical or transition risks, and we'll discuss those also a little bit later. But also for those using S2, companies are also expected to use the IFRS industry-based guidelines. So just some starting out questions for you there, but let's look at a little example here. This is another mining company. This is Goldfields Integrated Annual Report from 2023. And this extract on the slide, we can see very simplified which risks the company has identified. We also get information here about how they have identified them using a prioritization matrix, which they explain in a bit more detail around that image in the report, and how the risks align with the strategic priorities and what mitigation policies the company is using. So a lot of information on, a one little infographic in this slide, but that touches on a number of the things that we've talked about in risk identification. Now, we also mentioned time horizons. I had talked about time earlier on at the beginning in module 1, but then I also just mentioned again here in the strategy component, we wanted to understand kind of within what time horizons these risks or opportunities are expected to come to fruition. So the standard asks you to identify exactly, within which time horizon the financial or the risk or opportunity is going to come to fruition, but it does not define exactly short, medium, and long-term horizons because those actually vary between companies. And they depend on many factors. So as you can see here, they can depend on investment and business cycles. They can depend on strategic planning horizons, on the life of assets, or many other factors. So it's important that when you are providing that time horizon information, when you're identifying, for example, that you're expecting to see certain effects of climate-related or sustainability-related risks and opportunities at particular time horizons, that you define that for the reader of your report and for the main audience of your communications. And also that those time horizons make sense for your organization. If you have, for example, either investment or business cycles that are kind of on 5-year increments, for example, it wouldn't make sense to, put all of your time horizons at 2-year increments, making sure that you're really aligning with what makes sense within your organization, within the industry. Then there was another kind of high level component of the strategy area that was looking at current and anticipated effects. So some of the questions that you might want to be looking at in this area are on your screen now. And given that the first high-level category of strategy component relates to identifying the risks and opportunities that could be reasonably expected to affect the entity's prospects, I think it's only natural that the next kind of area we look at is disclosures pertaining to what exactly that effect is and where it occurs in the business. So these are some questions to get you start thinking about that, such as kind of what are those current and anticipated effects expected, and how are they going to be seen within the organization, where are they going to take place, and importantly also, what are the actual and planned responses that these effects have been identified to address. Now let's look at another example here. This is from BASF's 2023 annual report. So the company really acknowledges that their strategy is actually quite highly affected by the changing climate, in particular scarcity of natural resources and pressure on ecosystems and growing population. And as we discussed in the first set of questions for strategy, they are able to show which risks and opportunities they expect to have an effect within their organization. And in their report, they explain these effects. They say that their business, which is in the chemistry business, has a key role to play in addressing those challenges identified, including through innovation, using raw materials more efficiently, reducing waste, and enabling healthy food production and climate smart mobility. So as well as the changes that they hope that chemistry will offer society and the economy, the company itself has identified that it will need to go through profound changes. And these transformations all along the value chain are shown in a diagram on the right, where we see that the company's supply chain, production, and products will all be affected. Now, a company is required to disclose both quantitative and qualitative information, particularly about current and anticipated financial effects and sustainability-related risks or opportunities. And the standards set out criteria for when only qualitative information is required. So most of the time we do want quantitative information here, but in some instances, so for example, for current and anticipated financial effects, when a company cannot separate the effects of climate-related risks or opportunities from other effects, or if there is a high level of measurement uncertainty, then maybe you might want to use qualitative information, and you can do so in those circumstances. Also, for anticipated financial effects only, if the entity does not have the skills, capacities, or resources to provide the quantitative information, then qualitative information can be used. So this is especially helpful for companies just getting started on measuring some of these areas. At least there is kind of an ease into it. And as you do work towards building up those skills and capabilities, you can move into more robust quantitative analysis. Now, there was a kind of final high-level section we discussed in the strategy area when we looked at it at a high-level area, and that was resilience. So these questions help you to start thinking through the resilience of organizational strategy and business model to sustainability risks, and also obviously capitalizing on those opportunities. So the first part was looking at the risks and opportunities that are going to affect the reporting company. The second part was, what is that effect exactly? And now this group is looking really particularly at how the company is prepared for those uncertainties, ensuring its resilience into the future. And I think this really gets into the practices and the processes that a company has in place to assess its own resilience and to make strategic adjustments when it's needed. So disclosure include information on what type of assessment is used and how scenario analysis, for example, is used. And at the heart of it, resilience disclosure requirements really ask an entity to disclose first its assessment of climate resilience, and second, the inputs and key assumptions used in, for example, a scenario analysis. And we'll dive deeper into a scenario analysis in a moment, but some key questions you might want to consider are there on your screen now. Now let's look at what this might look like in practice. I see we're actually getting closer on time, so I think we have time to do both these examples. So in this example, this is from Stora Enso, which is a Finnish and Swedish forestry product company. And it shows us in this kind of small diagram on the top right-hand side what sales are likely to look like in 2030. So Stora Enso distinguishes here between essential and growth business in this very small but yet very powerful infographic. And they do, of course, provide a lot more information about that in the text along with it. We don't have in that infographic a ton of numbers, but we do have an immediate picture of where growth is anticipated and also detail about the company's kind of long-term vision. And in the text, we can then see more about the current and anticipated changes to the business model, and they discuss a recent transition which they describe as proactively repositioning the business from largely a pulp and paper company to a renewable materials company, ensuring what they say is their future for many, many more years to come. So they give a sense of how the growth businesses will then expand through acquisition and other entities and converting machines and through innovation. Now, another example we have here is from Solvay, which is a Belgian multinational chemical company. And here we can see how they're using a scenario analysis. Now, this is quite small, the text, so you might want to take a look at this on your own time. Also through the handout, you have the link directly to that example. But in particular, I want to highlight here how they are very transparent about the estimates, and they note that they have been, these estimates have been developed based on using a scenario analysis tool. And sorry about the noise there, hopefully this loud vehicle passes soon. But as you can see here, they do provide kind of all the detail we want to understand about how they're using a scenario analysis. So if you're using such a tool and the standards do require you to use a scenario analysis, investors need to understand how you're using it. So in this excerpt, they note what assumptions they have used. They indicate that they used a scenario analysis tool from a leading consulting firm to identify the assumptions used for their assessment. And they also highlight that internal experts worked together with those consultants to conduct that assessment. And the bottom half there, you can see that they assessed kind of three core business areas, and they actually in all three identified that they had opportunities that they could capitalize on and how they were going to go through and make sure that they were capitalizing on those opportunities. Now, let's quickly do one more poll here. Now, this poll, a quick quiz for you, asks a company may choose to disclose only qualitative information or a combination about current and anticipated financial effects when, and this was only a couple slides ago, so hopefully you were listening. A is the company cannot separate the effects of a climate-related risk or opportunity from other effects, for example. B, maybe there is a high level of measurement uncertainty. And or C, the quantitative information maybe sheds negative light on the company. So in which of these three circumstances is it okay to only provide qualitative information? And I'll give you a moment to fill that in. I noticed too, Shahid, a great comment in the chat that, yeah, indeed, so far, none of our examples are really focusing on companies that have adopted the ISSB because the examples came out shortly after the standards came out. But as you rightfully note, Shahid, in the chat, it's still, it meets a lot of the requirements of the standard. So many companies are already producing a lot of this information. And I'm sure many of you, especially using integrated reporting, will already be well on your way. Now, you've all done a fantastic job. So everyone's listening very well in this poll. You've all really gotten it right. So the first two, indeed, those were two of the kind of particular scenarios where qualitative information can be provided and quantitative can be omitted. But the third one is not. So if quantitative information sheds negative light on a company, that is not a reason to not disclose that information. Great. So well done on that, everyone. Glad everybody's still here with us. And I'm going to pass over to my colleague Lois to look at the climate-specific considerations for strategy. Over to you, Lois.
Yes, thank you, Tiffany. Well, we've looked at the governance requirements already, and there are no major differences between IFRS S1 general requirements and S2 in relation to governance. They ask for broadly the same thing. But on the strategy requirements, there are some climate-specific considerations. So we're going to go through those now. Now, although the climate requirements are built on the TCFD's recommendations and are broadly consistent with them, as we saw earlier when we referred to the mapping document that's been done, there are some differences. And if we run through these, not only does it help people understand the difference between S2 and TCFD, but it's also like a list, if you like, of some of the things that you'll find in S2 if you haven't yet had an opportunity to read it. So the first thing is that S2 requires a company to refer to and consider the applicability of industry-based disclosure topics. And they can find this industry-based guidance in an appendix to S2. So it gives you a starting point for thinking about what topics might be of most relevance in your strategic climate disclosures. Secondly, S2 requires information about where in the business model and value chain, climate-related risks and opportunities are most concentrated. Thirdly, it requires more detailed information on the effects of climate-related risks and opportunities, as Tiffany just explained, not just on the business model and the value chain, but also on the financial results. And in doing so, the standard sets out criteria for when quantitative and or qualitative information is required when making disclosures about the current and anticipated financial effects of climate-related risks and opportunities. Now, recognizing that this is difficult and new, there are various easements in S1 and S2. So in the case of the financial information, for example, but this does apply elsewhere, the standard just requires that companies use all reasonable and supportable information available to it at the reporting date without undue cost or effort, and that they can use an approach to disclosure that is commensurate with their circumstances in relation to specific requirements, including the qualitative and quantitative disclosure of anticipated and current financial effects. Now, looking at scenarios, yes, the standard does say to companies that they should use climate scenarios to inform their assessment of the company's resilience to climate-related risks and opportunities, but the standard does not specify what particular scenarios should be used. There are lots of resources that you can refer to, but the standard itself doesn't say which scenarios should be used for the resilience analysis. And of course, the standard does require additional information to be provided about the company's resilience assessment, including things like where they have encountered significant areas of uncertainty during the assessment, what is the company's capacity to adjust and adapt its strategy and business model over time, and details about how and when the scenario analysis was carried out, so readers can tell how up to date it is and the basis on which it was conducted. Let's look at another particular aspect of S2, and that S2 requires that a company should disclose details of any climate transition plan it may have. And a transition plan is described as an aspect of the company's overall strategy that includes targets, actions, or resources for the transition to a lower carbon economy, including, for example, greenhouse gas emissions reduction plans. So because the transition plan is an aspect of the company's overall strategy, the first point to note about this is that the transition plan should align with the company's main strategy, business case, business motivation, and so on. And the decarbonisation levers that are used for the transition should be those that from a business point of view are most economically and technically feasible for the company to use. Secondly, the transition plan could align with external goals, such as some people have raised this in the chat I see with the Science-Based Targets Initiative, and there's lots of other resources on transition planning. So does it align with climate neutrality goals set at national or international level and national net zero pledges? Thirdly, the transition plan should set out the long-term goals that the transition plan is designed to achieve, along with the mitigation and adaptation activities that will be used to advance that long-term goal, and the targets and interim milestones that will be used to monitor progress towards those long-term goals. The transition plan should be transparent about any of the dependencies, risks and challenges that apply to the plan and that may jeopardize its execution. And they should also explain how they will deal with any residual or unabated greenhouse gas emissions. So what will be the treatment of the things that the transition plan is unable to deal with in terms of unabated GHG emissions, for example. The penultimate point says that the transition plan should consider whether there are sector-specific pathways set out that help inform the transition plan. So there's a number of organisations, including, for example, the Mission Possible initiative, that set out transition plans for particular sectors, including hard to abate sectors. And it's good to look at those pathways that they set out to understand how your transition plan relates to those. And finally, it's important to consider how the transition plan will be evaluated by the readers, by investors and others, and whether the transition plan has the hallmarks of credibility. And there are quite a number of organisations, including CDP actually, that set out the hallmarks of a credible transition plan. So finally, on the transition planning, I just wanted to point out that there are quite a lot of resources available, and this is just really a snapshot. In the middle of the screen, you see the resources that are offered by GFANZ, the Glasgow Financial Alliance for Net Zero, and they set out pathway expectations for sectors, as we've just talked about, for the real economy and for financial institutions. On the far right of the screen, you see the Transition Plan Task Force disclosure framework. Now, in addition to the disclosure framework, the TPT has issued a whole range of resources about how to do transition planning and transition plan tools. So that's worth having a look at. But on the left-hand side of the screen, in the triangle, you see that TPT at the top and GFANZ in the middle. Their work is designed to support what the IFRS Foundation says about disclosures, that the companies should disclose their transition plans as an aspect of their overall strategy. And in fact, you might have seen that there was an announcement just in June 2024 at London Climate Week that the IFRS Foundation is going to take over responsibility for disclosure aspects of the transition pathway task force work. So this is an example, as I said earlier, I would mention it to you about further harmonisation and simplification in the sustainability reporting landscape. So participants, thank you so much for your enthusiasm, for your marvellous questions. We've been so distracted by them because the quality of your questions is excellent, and I hope you're getting the answers you need. But we're now going to have a little break with relaxing music for 5 minutes. So enjoy your break, have a stretch, a cup of tea, and we'll come back to you after the break. Hello, everybody, and welcome back. Hope you had the opportunity for a little stretch there and that you're ready to proceed with the second half of our training. So we're now moved on to the third type of core content we see in the requirements, which is about risk management. And really, these disclosures are a little bit different about risk management because they're really focused on process. So they're asking, what is the process that you use for risk management, and is it integrated into the company's overall processes? So let's go a bit deeper into the type of questions you might want to evaluate as you think about the answering the requirements on risk management. So really you need to consider what processes and policies are being used to identify, assess, prioritize, and monitor sustainability related risks and opportunities. Now, somebody in the chat I saw earlier was asking, well, how does this differ from our normal enterprise risk management process? It might not. You might be using your existing process, perhaps looking at the COSO framework, the Commission of Sponsoring Organisations of the Treadway Committee. It might be your existing policy, but as we'll look at later, it might need to be something that you have adapted. Secondly, what processes and policies are being used to monitor the opportunities, and is the sustainability related risk and opportunity management integrated into the overall enterprise risk management process? As we say at the bottom, you can find a summary of the requirements in the checklist. So what might be included in these disclosures is you would want to say something about the inputs and parameters that you use for risk management, whether and how the risks and opportunities are prioritized. How is the nature, likelihood, and magnitude of risks and opportunities assessed? How is the risks and opportunities monitored over time? And something else you might want to look at and disclose is whether any of the processes have changed since the last reporting period. So as we move on, let's have a look at some of the climate-specific considerations about risk management. So as with we just saw on strategy, there are some things to consider, particularly in relation to S2. And the first thing is that the S2 requirements are broadly consistent with the TCFDs, except that for S2 you need more detailed information about the input parameters you use to identify risks, whether and how a climate-related scenario analysis is used to inform risk identification, as well as your resilience assessment, which it must be used for, and whether your risk management processes have changed. And as we said earlier, you might need additional disclosures on the processes used to identify, assess, and prioritize climate-related risks and opportunities, and how this is integrated into and informs the company's overall risk management process. So let's have a look again at something else about what's specific in S2, and that is that in S2 we get a definition of what is meant by climate-related risks. So building on the TCFD, climate-related risks are categorized as transition risk that arise from efforts to transition to a lower carbon economy, and these are often categorized as policy and legal, technological, market, and reputational risks. The other main category of climate-related risk is physical risk, which can be acute, and these arise from specific weather-related events such as storms, floods, droughts, and heat waves, and chronic physical risks, which arise from longer-term shifts in climatic patterns, including changes in precipitation and temperature, sea level rise, reduced water availability, and so on. So in the middle of the slide here, we have some examples of how these risks might manifest in terms of increased pricing of greenhouse gas emissions, more reporting obligations like we're talking about today, exposure to litigation, costs of technologies to support the transition, changing consumer behaviours, uncertain market signals, changing weather patterns, and so on. But the important point to note here is that in all cases, there may be current or anticipated financial effects that affect the company's cash flows, its access to finance, its cost of capital, and these financial effects can manifest over different time horizons, the short, medium, and long term. Similarly, we have a definition of climate-related opportunities in the sense that they're categorized types of opportunities we might have manifest in resource efficiency, use of different energy sources, access to new markets, development of new products and services, and greater resilience to climate-related risks and opportunities. We have some examples in the middle of the slide about how these risks and how these opportunities might be shown. And in particular, at the bottom there, we see that it might give you access to new markets or to be able to develop new products to differentiate against your competitors. And we saw this in the example that Tiffany gave earlier from Stora Enso. It might mean that you can substitute resources substitute resources with more climate-friendly resources and diversify your operations. But again, the thing to note here is that these opportunities can give rise to financial effects that affect your cash flows, access to finance, cost of capital, and over different time horizons. So I'm going to turn back to Jarlath now to take us through an example and to take us on to look at metrics and targets.
Great, thanks, Lois. So we have an example here from the UK. NATS is the UK air navigation service provider. It handles air traffic control in the UK and over the North Atlantic. Now, many of us will already know how bad weather causes delays for airlines and airports, and of course, as us as passengers. And this can often lead to increased CO2 emissions due to aircraft circling in holes or even being diverted if airspace gets congested and inefficient. Delays could worsen in future with increased frequency and severity of bad weather events. However, over the longer term, changes into the climate patterns may influence the jet stream on the North Atlantic, and that could shorten times for some journeys, but also bring increased turbulence and thunderstorm activity for other flights. The disclosure here provides important details on how this particular risk was assessed and how it was deemed to be material. And of course, building physical and operational resilience will need to be addressed in its strategy and of course in its long-term investment plans. Now, we'll now spend some time looking at the disclosure requirements on metrics and targets in a bit more detail. Excuse me, and this is the final core content area, of course, of the standards. Questions to evaluate. So let's start with metrics and looking again at some of the key conversations that should be happening in your own company to help inform these disclosures. Requirements on metrics are designed to enable investors to understand a company's performance in relation to these risks and opportunities. Preparers shall disclose information explaining how the metrics are defined, if they're absolute or relative, if they've been validated by a third party, as well as the methodology involved. So, for example, what was the method of calculation? What were the inputs? Are there any limitations? And what assumptions were involved? Therefore, some questions that can be asked internally involve considerations on the metrics being used, how they're being defined and calculated, and how performance is being tracked over time. The standards also provide detailed guidance on how to ensure metrics are useful for investors. So, for example, metrics should in the end help investors or report users to be able to better understand your company's performance in relation to these risks and opportunities. They're expected to vary depending on the industry that you're in, and industry-based guidance and the SAICA standards can provide more information. And some of this has already come up in the Q&A panel so far today. And these, of course, the industry-based guidance and the SASB standards are available on the IFRS website. Metrics can also be taken from a source other than the ISSB standards or be developed in-house as long as they meet the other requirements. Let's move on then to the second part of this category, which is targets. And again, this has come up a couple of times in the questions so far. Targets are usually set by companies, but in some cases they can be required by law or regulation. And for each target, the company is required to disclose the target, whether qualitative or quantitative, and whether it's been set voluntarily or by law or regulation, as I said, the metric used to set that target and to monitor progress towards achieving it, the baseline period from which that target is measured, as well as the period to which the target applies. What's the end point? So, for example, many decarbonisation targets are long-term and are often then accompanied by milestones or interim targets along the way, and these should be disclosed. And you should also expect to see performance against each target disclosed, and as well as an analysis of trends or changes in the company's performance. And finally, if there's been any revisions to the target, then you'd want to disclose that and provide an explanation to justify it. These questions can help you get started on making sure you have the key information that will assist you in meeting some of these standards. And I think Lois is going to take us through an example next.
Yes, thank you, Jarlath. This is an example from a company called ArcelorMittal, which is a multinational steel manufacturing and mining corporation. It's from their 2022 annual report. And what we're focusing on in this extract is the way in which ArcelorMittal describes their targets. So first of all, they tell us they have an ambition, and this sets the context for their target. And their ambition is to have a leadership position within the steel industry and to achieve net zero steelmaking globally by 2050. The targets they set to support that are in the second paragraph on the left-hand side. So they've set targets to reduce carbon emissions intensity by 25% globally and 35% in Europe by 2030. So here you can see you can have different targets for different regions, and they've also specified the time frame to which the target applies. They also tell us the scope of the target in the second paragraph by telling us that it covers both scope 1 and 2 greenhouse gas emissions for steel and mining per tonne of crude steel. So we know very much what that relates to. They tell us that they have a roadmap till 2021 to inform these targets, and they tell us in the first paragraph there what sort of investment they're putting into achieving their commitments, which is $10 billion. On the right-hand side of the screen, I won't go into this, they tell us the assumptions behind their targets and some of the dependencies for success, including things like a supportive regulatory framework. Hand back to you, Jarlath.
Great, thanks, Lois. That's really helpful. We often get we're going to talk about climate-specific considerations next on metrics and targets, and we often get questions, as you probably won't be surprised, on how do you transition from TCFD to ISSB, and I'll run through this slide, but I just also wanted to say there's a lot more information both on the SSE website and the IFRS Foundation's website on this topic. It's one of the most frequently requested questions that we receive. So the disclosure requirements for metrics in S2 are broadly consistent with TCFD. And you know, we heard from, I think you already, most people indicated they had a good understanding of this from that question early on in this morning's session. But I just wanted to pick up on a couple of things. as I said, the requirements in S2 are broadly consistent with TCFD, except for S2 requires disclosure of industry-based metrics, which is relevant to a company's business model and activities. We don't see that in the TCFD recommendations. S2 also requires additional disclosures related to a company's GHG emissions, including, so for example, separate disclosures for the consolidated accounting group or joint ventures, JVs, as well as, this is one that it can be tricky, as well as information about companies' financed emissions. In addition, S2 sets out a Scope 3 measurement framework to provide additional guidance for preparers who are looking at Scope 3 perhaps for the first time. And while S2 doesn't explicitly require a company to disaggregate its emissions into the individual Kyoto gases, S1 includes requirements on disaggregation that would result in the disclosure of these constituent gases if disaggregating them provided material information. So you don't need to do it unless splitting those gases up and disclosing them separately would provide material information to your investors. And as I said, there's more information on climate metrics in the SSE training tool on this topic, and we'll share a link in the chat. And there's more information, of course, on the IFRS website as well. Oh, sorry, I think I've gone too far ahead. There's a lot on this slide. Similarly, there's a few differences when transitioning from TCFD to S2 on targets as well. So, for example, S2 requires disclosures about how the latest international agreements on climate change has informed target setting in your company, and whether the target has been validated by a third party. And there was a couple of questions, I think, earlier on SBTi in the chat as well. S2 also requires disclosures of more detailed information on greenhouse gas emission targets, including additional information about the planned use of carbon credits to achieve your emissions target, if that's what you're doing already. And S2 also includes additional requirements to disclose information about the approach to setting and reviewing each of these targets, as well as how it monitors progress, as well as how you monitor progress against each of these targets. So, for example, including whether the target was derived using a sectoral decarbonisation approach. And of course, there's a lot more information in the standards themselves. We're just trying to summarise it here, in addition to the guidance I've already mentioned. So, moving on to that next slide on greenhouse gas emission metrics. And I'm pretty confident most people will have a fairly good understanding of greenhouse gas emissions, but I can't assume it. So I'll just spend a minute or two on this. Greenhouse gas emissions tend to be the main focus when we get questions on metrics and targets. And so for anyone who's not familiar with these and is just coming to this for the first time, the language can seem a little bit peculiar. But essentially, Scope 1 emissions refers to all direct emissions that occur from sources owned or controlled by a company. So, for example, it could be from your own fleet, your vehicle fleet. If you've got a plant or machinery, it could be emissions or oil-based emissions from your equipment, refrigerant gases in air conditioning, and so on. Scope 2 includes emissions from the generation of, mainly for most people, it's electricity. But the category includes acquired and consumed electricity, steam, heat, and cooling. As I said, mainly it focuses on electricity for most people. And Scope 3 is everything else, upstream, downstream, indirect emissions that occur right throughout your value chain. S2 requires a company to disclose its absolute Scope 1, 2, and 3 emissions in accordance with the GHG protocol, which most people will be familiar with, unless a jurisdiction requires a company to use a different approach to measurement, and that does happen. And if you're using a different approach, there's a transition relief to use that method in your first year of applying the standard. And also, just as a reminder, what we just talked about a minute ago, disaggregation of emissions is required if the information, when you disaggregate it, is deemed to be material. And I think Lois is going to take us through an example.
Yes, thanks, Jarlath. This example is from Enel, which is an Italian manufacturer and distributor of electricity and gas. And in this little extract, this is an example showing the way in which Enel reports their greenhouse gas emissions under Scope 1, 2, and 3, but also how they disaggregate those that information. So at the top of the page, you can see the company's carbon footprint, and they've broken it down by Scope 1, 2, and 3 emissions, and they've given us a total at the end. The pale green column shows us the emissions in 2021 and the dark green in 2022. So in this little diagram at the top of the slide, we see the breakdown of the emissions and the comparison between 2 years. At the bottom of the page, you can see how the Scope 1 emissions are broken down by business lines. So you can see immediately that the majority of Scope 1 emissions come from generation from thermal sources, from the combustion of fuels in generation activities. You can also see that there are little numbers at the top, just underneath the line on the diagram, and these numbers refer us to notes. So the note 1, which is near the generation from thermal sources, tells us that the majority of those emissions were from carbon dioxide, but also some from methane. You can also see some little coloured dots on the diagram, and these refer to whether and to what extent the greenhouse gas source is considered within a science-based targets initiative target. So in this little diagram, it tells us a lot about the amount of emissions, the type of gas, the source, the trends over 2 years, and whether the emissions are considered in an SBTi target. So let's do another Zoom poll. And this question is, what is the objective of metrics? So I'm guessing that the poll's been launched, lovely. And for here, you can have multiple choice, so choose as many as apply. First, to understand performance in relation to sustainability related risks and opportunities. Secondly, to understand progress towards targets. And thirdly, to understand the company's assumptions for the future. It is a pleasure to give the presentation, share the presentation with this audience, because you're so enthusiastic in your responses. It's lovely for us as presenters sitting behind a screen to feel that participation. So let's stop there, because I think we've got 50% now, so I'll end the poll. Yes, most of you have responded A and B, to understand performance in relation to the risks and opportunities, and to understand progress towards targets. You are both right, A and B. Now, C is not wrong in the sense that the metrics and targets can help us to understand the company's assumptions for the future, but the reason this is not strictly the right answer is 2 things. First of all, when you read the standard, or if you've read the standard, which we hope you do, you'll see that each requirement starts with setting out its objective. And the objective in the standard of metrics and targets is as specified in answers A and B. Secondly, the reason we give you this question is to understand the difference between the different requirements. Of course, they're all interrelated, but the company's assumptions for the future are mostly associated with their disclosures on resilience, about how resilient the strategy is over different time horizons. So well done. Most of you had this completely correct, A and B, and it's a bit of a tricky question. So let's move now to look at the second part of the Align module. And here we've been through all of the core content disclosures now, the 4 main content areas. So what we're going to look at in a bit more detail now is how you integrate other disclosure requirements, that is other than the ISSB requirements that you may be required to or want to comply with. So how do you build upon this baseline? So when you build on the baseline, you'll know that there are other things to which you may need to report, including listing requirements, local requirements that may apply to listed and non-listed companies and may affect companies in your supply chain as well, and you may need to get information from them. There are policy objectives that may inform your disclosures, including policy objectives that aim to support sustainability, like tax incentives or subsidize for sustainable practices, or disincentives for certain behaviors or activities. Thirdly, there may be industry-specific practices and standards that apply to your company that you need to take into account, and some of the attendees on the line have referred to mining, oil and gas industry standards, for example. And finally, but importantly, there may be information you want to or have to disclose in order to satisfy the information needs of other stakeholders other than investors. So the communities with which you work, for example. So let's think about the adoption, if you like, of the ISSB standards. How do they become adopted by various jurisdictions? Well, this slide simply shows us that through its consultations with various jurisdictions, they have been deciding on whether and how to adopt the ISSB standards. At the moment, the more than 20 jurisdictions that you see listed here have already decided to use or are taking steps to introduce the ISSB standards into their legal or regulatory frameworks. And together, the jurisdictions you see here account for about 55% of global GDP, 40% of global market capitalization, and 50% of global GHG emissions. So we see a trend here towards at least considering adoption or committing to adoption of the ISSB standards. Of course, it's not just jurisdictions, but there are other things with which your ISSB standards might interrelate. So, for example, your CDP disclosures, and the ISSB's climate standard has now formed the foundational baseline for CDP's climate disclosure questionnaire. So ISSB is interoperable with CDP's questionnaire. The greenhouse gas protocol, there are governance arrangements in place so that the ISSB is actively engaged in updates to the GHG protocol corporate standard that I'm guessing many of you are using. And in fact, the GHG protocol must be used for measuring greenhouse gas emissions according to the standards. Then with GRI, the IFRS Foundation and GRI are looking at ensuring maximum interoperability between their standards again to really facilitate efficient and effective reporting for companies. We talked earlier about the Transition Plan Task Force and the fact that the IFRS Foundation announced in June that it will assume responsibility for the TPT's disclosure specific materials. At the beginning of our workshop today, some of you mentioned you were using the task force on nature-related financial disclosures materials, and ISSB will consider how to build on the recommendations of the TNFD to meet investors' information needs. Yes, GRI we've talked about very briefly, but there is a publication that you see on the left there, which sets out the interoperability considerations specifically in relation to GHG emissions. The two organizations have a joint commitment to identify and align common disclosures The analysis has been published, as I've said, and there's also collaboration to deliver full-on interoperability, starting with the GRI's 101 standard on biodiversity, and to align that with the work, the ISSB's project on biodiversity ecosystems and ecosystem services. And the IFRS Foundation is a convening partner of the GRI's Sustainability Innovation Lab in Singapore. So lots of work going on to harmonise and simplify the landscape. Now, of course, many of you have also mentioned the Corporate Sustainability Reporting Directive of the EU and the ESRS standards that support that. The IFRS Foundation and IFRAG, which is the standard setter for the European Sustainability Reporting Standards, have been working very closely to support interoperability between their respective standards. And as you see in the middle of the screen here, the most important outcome of their discussions is that they find that there's a high degree of alignment, particularly in relation to climate-related disclosures. The European Commission and IFRAG have made some changes to their standards to improve interoperability. For example, there's now an aligned definition on CO2 equivalent, which is consistent with the Greenhouse Gas Protocol. They have aligned their wording on anticipated financial effects, and there are some references that are designed to be reciprocal, for example, on the use of industry-based standards. So many companies are required to or may choose to use both types of standards, and they are being designed to be interoperable. And there's some joint guidance as well published by the two organisations on interoperability, and you can see at the bottom of the slide there is a link to it there. And many of you on this line, I'm sure, may be wondering about the interoperability with integrated reporting. So I'm going to hand over to my colleague, Laura Girella, now, who will explain that to us.
Thank you so much, Lois. And thank you for having me today. And let me bring in an integrated reporting perspective to this. So as you know, the integrated reporting framework has represented for us a source of inspiration for some of the concepts that we have embedded in IFRS S1 and S2. And in particular, if we look at IFRS S1, paragraph 2, you might recall and find the inextricable link between the value creation for the entity and for others, as well as the concept of connected information that Jarlav mentioned before. However, the contribution of the integrated reporting framework to the work of the IFRS Foundation doesn't stop there, because we also see integrated reporting as a complementary tool to IFRS S1 and IFRS S2 for investor-focused communication. In fact, as we mentioned before, IFRS S1 and IFRS S2 are location agnostic, and as such, their disclosure can also be embedded in an integrated report. In this respect, let me go back to two aspects and things that Patricia mentioned right at the beginning. One, which is about not to lose the discipline of integrated reporting, and two, this is nothing necessarily new for those of you who are already adopting the integrated reporting framework. And in fact, if you're doing an integrated report, you already have a well-suited architecture in place and are already providing information on risks and opportunities and how, for example, you're managing those risks and opportunities from a strategy viewpoint. So some of you might wonder and ask, what is the value added of including IFRS disclosures in the integrated report? So the answer to this is about the fact that in complementing your integrated report with IFRS S1 and S2 disclosure, you will be able to provide comparable, consistent, and reliable information on sustainability and climate-related information and risks and opportunities to investors, and making sure that this information is not obscured by other information. And in order to help preparers to understand the link between integrated reporting framework and IFRS S1 and S2, we have updated and developed some resources that are now all part of the ISSB Knowledge Hub. The first one is the frequently asked questions, the FAQs that we used to have since many years, but they now have been updated in order to better understand, making sure that preparers can understand the link between, for example, the risks and opportunities as conceived in the integrated reporting framework and risks and opportunities and information on risk and opportunities as defined in IFRS S1 and S2. Another resource that we have developed and published on the ISSB Knowledge Hub last year is the so-called mapping tool. It is an interactive tool which again is aimed to support preparers to understand how the core contents in the ISSB standards, the one that my colleagues already illustrated, and the content element in the integrated reporting framework interacts. And this is one possible way to see how integrated reporting preparers can start thinking about implementing IFRS sustainability disclosure standards in their integrated report. Last but not least, in May this year, we have published the updated Getting Started Guide. Again, this is a guide that it is mainly aimed to those that are new to integrated reports, so not the case for South African companies, but still you might want to take a look at it, again, to understand the linkages between the content elements of the integrated report and the core contents of IFRS S1 and S2. So some key messages on how to think about integrated reporting framework and IFRS sustainability disclosure standards. If we go to the next slide. So as I said, nothing new. This is not really about adding more disclosures. It is really about not obscuring the disclosure and making sure that you're able to provide, as I said, and I will keep on saying, comparable, consistent, and reliable information on sustainability and climate-related risks and opportunities to investors. And we think that South African companies are really, could really be the front runners in this respect on the basis of the long-standing experience that they have in integrated report. Another important concept that we don't have to forget is the concept of integrated thinking. Also in this respect, don't overlook, and you are very much familiar with this concept of integrated thinking, that integrated thinking also in embedding IFRS S1 and S2 disclosures is really one of the key enablers to understand integrated report, IFRS S1 and S2 disclosure as an holistic and systematic way to look at corporate reporting. With that, I'm going to hand back over.
I think we have a poll next, so maybe I'll take that poll. Great. Thanks so much, Laura, for making it so relevant for the local audience. We really appreciate your expertise. And I already saw there's some questions in the Q&A related to this, so hopefully you can also address those. Great. So we do have a poll here for you, which is my disclosure objective should consider the ISSB standards only, the ISSB standards and regulatory requirements, just regulatory requirements, or the ISSB standards, regulatory requirements, and other sources of guidance. And so far, everyone's doing very well. So I'll only give you a few seconds on this one because I think everybody knows the answer, which is fantastic. 5 more seconds. Okay. I'm going to share now the results, and a big applause for everyone. Correct. The last answer, D, was correct. The standards, regulatory requirements, and other sources of guidance is the correct answer there. Great. So with that, let's wrap up this unit. We're done with module 2 now. And before we wrap it up, let's just take a quick minute to remind ourselves a bit of what we learned. So we took you through all 4 core content areas of the ISSB standards S1 and S2. But an important thing to remember is that in reality, these areas do not operate in silos. Last module, we introduced that idea of connections. And we saw in our examples today that despite having 4 separate categories of disclosure, all these categories are very much interconnected as well. So keep in mind connectivity. Also, we discussed how your disclosures might go further beyond the requirements of S1 and S2, and we might, which we might be able to use to meet different stakeholder needs, or to meet regulatory requirements in certain jurisdictions, or to meet industry standards. So what's really important to remember when doing this is that the ISSB standards have been purposefully developed to act as a baseline. And the building blocks approach allows report preparers to then add additional disclosures on top. But in doing so, report preparers obviously need to be careful not to obscure the requirements of S1 and S2. Now, with that quick overview of what we learned, let's now come to our next Menti. So our next activity is looking at the content itself. We spent this whole unit looking at exactly what we want to disclose. So how do you go about identifying what you're missing in your disclosure and what's needed? So a few ideas to kick you off is maybe conducting a gap analysis to determine what areas your organization is not yet communicating to investors. There is a simplified checklist in your homework sheet, and we link to the SSE checklist in the homework sheet and in the chat we've shared a couple times. I can share it again with you. And this lets you kind of just get started. But then you want to also look at what enhancements or additional reporting requirements you might need to add on. And of course, don't forget using those standards is necessary as well. So let's go back to the Mentimeter now. We've already got some good answers here. Well, I'm not sure what A and D refers to, but the other answers look to be on the right path. So what tools can you use to identify the gaps in sustainability related financial information in your current disclosures? We've talked about kind of the route forward, where we want to get to, but where are you at now and how do you know what needs to get done? I see a lot of, gap analysis checklists, compare to other reports. We keep saying don't copy your peers, but of course, be inspired by them. Look at what they're doing. Learn from other peers, whether it's good practice or bad practice, you can still learn from them. Data collection and management, sure, especially comparing the data you have already to what's required in the standards and looking at whether you might not have some of that data and you need to move forward on that. The disclosure checklist, certainly. Great answer. IFRS S1 and S2. Use the standards. Jarlath happens to be in the London office today, but normally when he's back home, he has the standards with him and he shows they're not actually that huge. You can dive into those and start making use of the standards themselves. A materiality assessment. And that's also a really good starting point as we've been talking about kind of those financial effects, kind of understanding what's required. So I think you all have a really good start onto your next part of your homework. So take note of what you did write down, think about how to move forward on that. And I'm going to pull us back to the slide deck so that we can continue on here. 2 seconds. There we go. Great. And so that brings us to Unit 3, the implementation. And I'm going to pass back to Lois to kick us off in this unit. Thanks, Lois.
Thank you, Tiffany. So up to now, we've talked a lot about what the standards say, and they tell a company what to report, the requirements for disclosure. Because the standards focus on what should be reported, there is some, but there's a limited amount of information about how the disclosure should be made. So we talked earlier about the fact that the standards don't specify which scenarios to use. But what we want to do in this implementation section is to share with you some information, at least, about how you can go about implementing the standards. We're going to cover 3 things. First of all, how to identify sustainability-related risks and opportunities. Secondly, what sort of evaluation processes the company might need to go through, what judgments it might need to apply, for example, on things like identifying material information. And thirdly, we look at integration, and that is mainly how your existing processes, practices, teams, staff members, expertise can be used and adapted and developed to develop your sustainability related financial disclosures. So let's start with identifying sustainability related risks and opportunities. Of course, this forms the heart of the disclosures. Most of the disclosures have something to do with your sustainability related risks and opportunities. So how do we identify them? Where do we get them from? Well, these risks and opportunities come from interactions between the companies and its stakeholders, with whom it works and whom it serves in its communities and its customers and its value chain, the society in which it operates, and the natural resources upon which it draws. So together, the company and the resources and the relationships throughout its value chain form this interdependent system that forms the context for understanding the risks and opportunities. Now, the sorts of things your business might want to consider then is, what are its dependencies within this interdependent system? For example, customers and raw materials. What are the impacts that the company makes that could then become risks and opportunities in the future? So its impacts on natural systems, communities, national finances, and so on. And what are the outcomes to which it contributes? Things like customer satisfaction. Also, the context of this interdependent system is shaped by regulators with whom the company works, the communities, customers, and business partners the company has. And also there will be changes in all of that context through new consumer behaviors, patterns, new and changing regulations, different resource considerations about availability, quality, and cost. And of course, that big picture is what you need to look at to understand how to identify the sustainability related risks and opportunities. That will be informed by your enterprise risk management system, of course, and could also be informed by looking at things like the World Economic Forum's Global Risk Report, which sets out what they sometimes call mega or major trends that may inform the types of risks that your own company is exposed to. Of course, also, according to the ISSB standards, companies must refer to and consider the applicability of sources of guidance when identifying sustainability-related risks and opportunities, and these include the SASB standards. So a lot to think about there, but also a lot of ways in which you can start to identify sustainability-related risks and opportunities using guidance and other sources. Let's look at an example of how Yara has done this. Now, Yara is an international global crop nutrition company. And what we're looking at here is the way in which Yara describes how they've identified sustainability-related risks. In the top right-hand corner, you can see that they've started with looking at the megatrends that inform and influence Yara's market. So things like geopolitical and trade uncertainty, growing and increasingly urban global population. So what they've done by looking at that is they've sort of set their understanding of risks and opportunities in the context of those mega trends. Then in the bottom of the slide, where you see opportunities and risks from the mega trends, this is how Yara has assessed what the particular risks and opportunities are for them. So the risks they see as regulatory changes, consumer demand for sustainability, the need for optimized fertilizer use, which could in fact lead to lower fertilizer demand and lower growth. Other things include, how the competitive landscape could be disrupted, and the fact that there could be environmental costs and taxes that will increase. On the opportunities side, they show that there's the potential to use digital tools to enable new market channels and reduce the yield gap, because these digital tools are able to increase farmer connectivity. They're anticipating there may be opportunities from the mainstream adoption of clean ammonia and hydrogen, which are the products that they help to develop. There'll be a focus on soil health, water use and biodiversity, which means that optimal fertilizer impact could have a positive impact, and so on. So in summary, what they've done here is that they've identified risks that pertain to their own company, but informed by megatrends and the context within which they work. Let's look at one more example, and this example is from Nest. Nest is a company based in Finland, and they're a producer of sustainable aviation fuel, renewable diesel and feedstocks for the chemical industry. So they're using science and technology to transform waste and other resources into renewable fuels and circular raw materials. So they have a sustainability focused business model. So this extract comes from the climate section of their annual report, and it shows how they identify and assess risks and opportunities using 3 different temperature scenarios. So the net zero world is about a 1.5 scenario, net zero EU and America by 2050 is a 2-degree scenario, and compromised climate targets is a 2.5 to 3-degree scenario, and they're looking at this over a time frame to 2050. So the extract shows an overall assessment of whether the scenario is positive or otherwise for the company in terms of their risks and opportunities, and also what the indicative financial effect is. So you can see that right at the bottom, that the indicative financial impact is positive in the net zero world, slightly negative in the compromised climate target world, and perhaps that's what we could expect in a company like this that has a very sustainability oriented business model. So we talked a little bit about this earlier, so I'm not going to go into it in detail, but the point is that the ISSB recognise that some of the requirements are quite difficult, they're quite new, they're quite technically challenging, and that companies may need some time to develop the resources and practices needed to implement the recommendations. So they say that in applying certain specific requirements, a company is only required to use all reasonable and supportable information available at the reporting date without undue cost and effort. So what does this mean? Well, reasonable and supportable information is information that's specific to the company, therefore known to the company, that takes account of the external environment in which they operate, also something known to the company, that includes past events, information about past events, current conditions and forecasts. And in some cases, this information is actually specified by the sustainability standards about what is reasonable and supportable in different circumstances. I'm going to hand back to Tiffany now.
Thanks so much, Lois. And that brings us to our second section of the implement module. So once risks and opportunities are identified, of course, companies need to evaluate what are these effects of those risks and opportunities. And this can often be a very daunting process at first, but we'll briefly review a few concepts that can help you along your way. So first, to help investors understand a company's resilience against climate risk, the standard requires a company to disclose information about the implications of climate change on its strategy and business model. And it also asks for the company's financial and operational capacity to adjust or adapt over the short, medium, and long term. So, for example, you might test your company's resilience against new regulation to limit certain high emission activities, for example, or your company's ability to respond to changing crop yields due to more frequent heat waves, as a few examples. And a scenario analysis is a tool that companies are using to do this. It does not predict the future, but it does allow you to test your resilience in the future. In the interest of time, I'm going to move straight into an example. This one comes from Cemex, which is a Mexican multinational building materials company that's active in over 50 countries. And Cemex also used here a scenario analysis, and in its integrated report, it illustrates how it combines this analysis with its assessment of progress against its stated policies, SDG commitments, and its net zero targets. And this table describes both those risks and opportunities that are identified, and they also include in a table beforehand the source, the temperature range, the reference temperature scenario, etc. Remember, as we were talking about before, that it's not enough to just use a scenario analysis. That's great for your own organization, but of course, investors need to understand what scenarios you were actually using and how you made those assessments and what assumptions you were using. I think what's particularly interesting about this example before I move on is actually through this analysis, they were really able to identify a number of opportunities for their business. And they found that the opportunities actually outweighed the risks. So even though maybe a lot of companies are a bit daunted about sharing information about sustainability related risks and opportunities, in a lot of the examples, what we're finding here is that the opportunities are what they're uncovering. So it's a great benefit to your company as well to go through this process. Now, just quickly before I pass back to Lois, anticipating the materiality of future events can also be particularly challenging. So to help with this determination, IFRS S1 asks that you consider a number of issues to help you with your determination. So you could think of this list here on the slide as a list of identifying all the steps and information you need to come to your judgment. So for example, companies should be considering all of the low probability but high impact events, also any uncertainty related to the company's future cash flows should be evaluated, for example. And another important point here is the need to reassess each after each reporting period. So for the final unit of this module, I'll pass back to Lois. Thanks, Lois.
Thank you, Tiffany. So I should think integration is something that's very well known to the audience here, many of whom are experts on integrated reporting. So we'll go through this fairly quickly, considering what new processes might need to be developed in a company and or how to integrate new considerations about sustainability related risks and opportunities into your existing processes. So considerations when creating or adjusting processes. We've already seen that the enterprise risk management process, the governance processes can be used and applied to sustainability related risks and opportunities. But what might you want to do if you're considering how to use and adapt processes? Well, firstly, there's a gap analysis that you can do, check for gaps in existing systems and processes, and whether, in the second point, they're suitable to be used for sustainability related risks and opportunities. The reason we say this is that sustainability related risks and opportunities have different characteristics to some other business risks and opportunities in terms of the way in which they manifest is much more uncertain. The time horizons over which they manifest could be much longer. And that's why also you might want to consider whether you need a new or different prioritization criteria for those types of risks and opportunities, like vulnerability and speed of onset. Have a look at your existing internal controls frameworks to see if they are suitable for use in controlling sustainability related risks and opportunities. COSO's got some fabulous guidance on this if you need it. Consider who are the contributors you need to your disclosures, which departments they work in, and what processes and expertise they have. Actually, the EFRAG has just published a status report on what types of departments are involved in disclosure, and they find that typically 5 or more departments are engaged in the CSRD implementation process, which has many similarities with ISSB. And they say that beyond the sustainability and finance departments, they find involvement from risk management, human resources, auditing, internal controls, procurement, communications, and strategy. So quite a lot of contributors to consider, but also how they are interconnected, and also what are the interconnections between different internal and external factors that might affect your disclosures. And then there is also the question of how you might deal with uncertainties. The uncertainties about sustainability disclosures could be quite a lot more significant than with normal disclosures, and you'll need to consider how to deal with them. And we've put a little resource at the end there that you might find useful. The other thing you might find useful is to develop an internal disclosure plan. A disclosure plan can be used as a standalone strategy or part of a wider disclosure strategy. And this just it acts as a reference point. So it is a permanent record of how the disclosures have been prepared, what judgments were made, how they were made, by whom, which departments, which systems and processes were used to inform that disclosure plan. It helps a company take control of its own narrative, because while, if you adopt the standard, it must be faithfully responded to. It does ask questions about your company. So this disclosure plan helps you take control of your narrative and the way in which management wants to disclose information. And it also supports the sort of collaboration and cross-functional team working that we've been talking about. So it's a useful permanent record. We're going to skip the next example, which is from Hammerson, but it's in your slide pack, and it just shows you what that company does in terms of making disclosures about how they prepare their disclosures. So in this next question, we're asking, is a disclosure plan required by the IFRS sustainability disclosure standards? Yes or no? Well, I can see a clear pattern emerging here, so very well done. I think I'll end the poll there. Thank you to all of you who have participated. You are absolutely right. There is no requirement in the IFRS standards that says a company shall make and disclose details of its disclosure plan. So very well done to all of you who said no. The reason we mention it, the reason we have it in homework, is because it's a helpful tool and one that we see many companies using and making disclosures about in their annual reports. So well done. Again, this is a question that many audiences we've worked with have got wrong. So very well done to this audience. And I'll hand back to you, Tiffany.
I thought we had one more poll. Do we not? We
Oh,
do.
sorry. Yes. Oh, yes. Now, you probably know the answers to this, everybody, because we've been through them, but we're asking, a disclosure plan can help a company take control of its narrative, support collaboration, act as a reference point for disclosure, or to skip full disclosure. This is a multiple choice question. I can't see the poll being completed, but I guess you can, Tiffany.
Well, I wonder if participants can't see it either, because nobody has answered.
Oh, I know.
Let me try to reshare it.
Yes. Poll is not showing. Oh, thank you, everybody, for telling us.
Relaunch poll. Let's do that. Let's see if it works now. Can you see it, everyone?
Yes, can see it. I feel confident.
Okay, so now it's working.
I feel confident everyone's going to get this right anyway. And we can see a pattern.
Already.
Yeah, we can see a pattern already. You know this. We'll end the poll and share the results. Of course, you're absolutely right. It's the first three, and it is not an excuse to skip full disclosure. Of course it's not. Over to you, Tiffany.
Great. Thanks so much. I'm just going to make sure we're out of this. Great. I'll stop sharing that poll. And that brings us to the end of module 3. So to wrap up this module, let's just remind ourselves of a few key things. So firstly, let's come back to those connections. I think this has been in every summary, so it must be important. So in the last module, we wrapped up by highlighting the importance of connections between the four core content areas of disclosure. We then learned in this module that there are many connections as well between a company and its external and internal environment. So these connections are what we need to focus on to identify these key risks and opportunities. And then the second thing we discussed in this module was related to evaluating those risks and opportunities. And a key component of that evaluation is consistency in your assumptions. So, for example, using a scenario analysis can be a very helpful tool, and it is required in S2 as it helps keep track of those assumptions. And if you're new to this, prepackaged scenarios such as those from NGFS can provide you with the assumptions that can be used for evaluating those financial effects. And then finally, as we've seen, even if some of the data is not data you're already disclosing, you may already be collecting it for different reasons, or you may have the appropriate practices or processes in place to be able to collect that data that you want to report. So you just need to make a slight adjustments in some instances. Don't start from scratch, especially since many of you are already well on your way of this journey. Now let's wrap up this unit with our third activity. We might not have time for a last one, so do put in your effort into this activity in case we run out of time for our last activity. This is the third homework activity we give you to think about on your own time, but to get you kicked off, let's start thinking about the gaps identified in the previous section and how you can use kind of existing or integrate new processes or systems to achieve those disclosure objectives. So some things to think about are the data collection itself. So how will you collect the data that is not already being collected, but is required by the IFRS S1 and S2? And then the management of it, identifying what teams are responsible for managing the data. And for this, we're going to come back to a Menti. I'm going to share again my screen here. And the question we're asking you to think about is what existing processes for data collection could be adapted to collect sustainability related information. And we already see kind of some of the software that you might be using. Some people might be using blockchain in order to do that. But I mean, the software that you're using already to collect financial information, and specifically if you're working with an integrated reporting format, you're already probably collecting a lot of this data. So just making sure that you're making the best use of that. Someone also said here stakeholder engagement, which is a really important answer, because a lot of this might require you having conversations with certain stakeholders that maybe you haven't had before, but you might already have those relationships set up. You might already be having those conversations. So making sure that that information is being shared with the appropriate teams. I also see financial reporting system and software. Yeah, you're likely using that already. So making sure you're adapting those tools. We see compliance reports, industry research, current existing processes in the organization, business reports, exactly. So you're all very well on your way for this next area. The important thing here is to start thinking about, what are you already doing that you might not be integrating this information into your disclosure. I see now we suddenly have a few hands raised. So if you're having any trouble accessing this, or if we need to help you, the QR code's not shared. That's why. Maybe that's it. Maybe that helps everyone. Just to note though, you can go back to the slide you had open before, but everyone who did participate, you did a great job. Those are fantastic answers. So I'm gonna come back now to our slide deck since we're a little short on time. We want to make sure we get all this information over to you. Great. So that actually brings us to our last unit on communication. And we have just over 30 minutes to finish this unit. And Tim, you've been working so hard answering all of these questions. Now we're going to give your fingers a break, but test your voice a bit and get you to take us through module 4. I'll pass over to you, Tim.
Thank you. Thank you so much, Tiffany.
We've got a bit of an echo. I wonder.
You still hear me fine?
Yeah, we hear you good now.
So we're now on to the last unit of the training. I still see a lot of people staying on since we started this morning. So well done to you all for staying on. We're on to the last one. So there are still a bit to cover here, but then after that, we'll let you go. So hopefully by now, everyone is comfortable with the initial why and what and how that we've discussed so far. In this unit, we are going to review the when and the where of sustainability related financial information. As with the last unit, we have 3 main sections here. And to get us started, we'll look at the location. So in this section, we are looking to clarify where sustainability disclosures should be located. So before we dive into the specific requirements of the standards, perhaps let's take a step back and think about sustainability disclosures in the context of a complete reporting package that would be useful to investors. And we have received some questions already on this topic, so hopefully this will help address some of those questions as well. So investors today already have access mainly to companies' financial statements, and they use them quite a lot in informing their decision making. So to be clear, ISSB standards are intended to elicit information about sustainability related risks and opportunities that is useful to investors to complement information that is already available today provided in companies' financial statements. And just to note here, ISSB standards complements financial statements that could be provided using IFRS accounting standards or other GAAP. So it is GAAP agnostic. It could be used with either accounting standards or the general GAAP requirements. So just coming back to the topic of this unit, which is about location, it's really key to think about this idea of a reporting package that we refer to as general purpose financial reports in the standards itself. So this idea of a reporting package is really important. So this is a reporting package that would provide useful information to investors. So that's the column in the box in blue here. Within the sustainability reporting space, we recognize that there are other standards, such as the GRI standards, in this example, which are intended to elicit information that meets a broader range, the information needs of a broader range of stakeholders. And in this regard, we hear from the market loud and clear that it is important that we work together with other standard setters, such as the GRI, to ensure that we could help companies to efficiently meet the information needs of both investors and a broader range of stakeholders as well, if they are required to do so or if they choose to do so. So again, coming back to the context of location, so in terms of location, then we'll look into the specific requirements in the standards about providing information that is material to investors when they are provided together with this additional information, which might be provided to meet these broader objectives. And just to give you some ideas of why sustainability-related financial information could be useful to investors' decision-making, these are some examples of the types of sustainability-related financial information. And if you look at these examples here, you'll see that these are the kind of information that would be useful to investors. They are not within the scope of financial statements, so you won't be able to get this information from a company's financial statements. And this is where ISSB standards come in. It is intended to elicit these type of disclosures that could complement the company's financial statements to meet information needs of investors. Now, we'll look into the specific requirements about providing information that is material to investors. So ISSB standards require a company to disclose material information about its sustainability-related risks and opportunities that could reasonably be expected to affect its prospects. So hopefully that part is sufficiently clear to you by now. That is a really important concept in ISSB standards. So we want information about risks and opportunities that could reasonably be expected to affect the company's prospects. So this means that a company does not need to disclose information that is not material. And this is true even if ISSB standards contain a list of specific requirements. If the information is not material to investors, then the company does not need to disclose them, full stop. There is no explanation necessary. If it is not material, then it doesn't need to be disclosed. And that's really key to our definition here. And when disclosing material information, there are some general requirements in S1 that a company is required to apply. So for example, information being clearly identifiable, use clear language when you explain this information, avoid scattering information. And these are all part of the concept of fair presentation, which seeks to ensure that an entity's disclosures fairly presents its actual sustainability-related risks and opportunities. And they are really designed, again, to provide useful information to investors. So by providing only material information, and in these ways, then it will really help investors in making use of information provided by a company. Another important factor to consider here is, and I'll go back to the earlier point that I made about presenting information that is material for investors with additional information that, for example, is provided to meet local jurisdictional requirements, that is intended mainly to meet public policy needs and not necessarily for investors. So what does the standards say about this situation? So the standards permit disclosures of such additional information in the same location as those information that is material to investors. But a key caveat here is that the disclosure of such additional information must not obscure the information, the key information that is intended to be provided to investors. So it is important for the company to ensure that material information is clearly identifiable and not obscured by that additional information. So provided that a company could do that, then they could still meet ISSB requirements whilst providing these additional information. We have a Zoom poll here to test your understanding. So the question that we have is, information should be disclosed in the annual report when applying ISSB standards if and we'll give it a couple more minutes or so. Just give it 30 more seconds. Have we got everyone? Yep. I think we've got a fair good number of people responding to the poll already. So absolutely, it is key that information that is disclosed in the annual report when applying ISSB standards does not omit information that could be reasonably be expected to influence investors' decisions. You don't want to omit this important information to investors. And then also B, it could reasonably be expected to affect the company's cash flows. So C is a nice to have, right? It is not a strict requirement of the standards. If it exemplifies the value of the leadership team, so you could provide that information, but that is not truly necessary. It is not a strict requirement of the standards. So A and B are the correct response here. I'll move on to the next one. So here we're going to look at the we're going to go back to this idea of reporting package allocation, right? So what do we really mean by this general purpose financial reports? So what we mean is that we want sustainability disclosures to be provided as within the same part of reporting package that is provided as part of the company's financial statements. So a company would provide their financial statements already, and that is key information to their investors. So we want sustainability disclosures to be provided as the same part of that reporting package, which we refer to in the standards as general purpose financial reports. S1 does not dictate where in that reporting package the information is provided. And this is really important given that the standards are designed to be used around the world and thus facilitate jurisdiction-specific requirements on the location of reporting. And I can see that we've had some questions already on integrated reporting, because naturally in the context of South Africa, that might be where the regulators require the disclosures of information to be. And so just taking into the context of different jurisdictional specific requirements on where exactly a company is expected to report their narrative information, for example, we deliberately tried to make sure that the standard could accommodate these different jurisdictional nuances. So it does not dictate where in the reporting package exactly. The most important factor to consider here is to ensure that the sustainability disclosures is provided as part of the same reporting package as the company's financial statements. So they must come hand in hand. So what does that mean practically? So for example, sustainability disclosures has to be provided at the same time as the financial statements. Sustainability disclosures has to cover the same reporting period as the financial statements. And for example, if the sustainability disclosures are authorized by the same body or individual authorizing the financial statements, then you could pretty much be confident that it is the same part of reporting package as your financial statements. So companies could take different approaches in the location of its sustainability disclosures and yet still meet ISSB requirements, as long as the sustainability disclosures are provided as part of this same package of general purpose financial reports. So the exact placement or location itself is often determined by jurisdiction-specific requirements. And then I'll pass on to Lois, who will walk us through an example here.
Thank you, Tim. Good to have you on the training. So this example is from a company called Ayala,
Lois?
which is, sorry, can you hear? Yeah.
I hear you well, Lois.
Okay, good.
Tim has it.
This is an example from a company called Ayala from their integrated report. And I know many of you have done integrated reporting, and you'll be familiar with the way in which this disclosure is set up using what we fondly used to call the octopus diagram, which is from the integrated reporting framework that shows the flow of capitals into the organization on the left-hand side, how they are used to create value within the organization, and then the outcome, which is the value generated for the company and for society and the economy. So the reason we're showing you this example is that we're talking about the effective and efficient communication of information. And what this diagram does is not only does it tell you what the value creation framework is, but it also acts as a sort of an index. So you can see where the page references are to where you find pieces of information about the value creation process within the integrated report. It also tells us how different pieces of information are connected, so that the diagram is used both for navigation, for connection, and really for a holistic summary of the company's value creation framework. Hand back to you with that, Tim.
Thank you, Lois. So then we'll look at another aspect of location here, which is the technology and format of disclosure. So Lois has already walked us through an example of what the presentation might look like, but it is also important to think about the technology and format of disclosures. And this is a topic that is close to my heart, taxonomy, digital reporting. So increasingly, corporate reporting is moving from PDF towards information on web pages with structured data sets, such as those data sets offered by many exchanges. And for this reason, ISSB has created the ISSB taxonomy to really support investors' use of sustainability-related financial disclosures prepared using the ISSB standards. So ISSB taxonomy itself merely reflects the requirements and accompanying materials of the standards. So that if you are familiar with the standards, then you should find the taxonomy fairly familiar as well. So it does not introduce any new requirement, and instead it is provided to enable the digital tagging of sustainability information that would make it more efficient to investors to use this information. So digital reporting has a number of benefits. So I've already mentioned the potential benefits to make it more efficient for investors to digitally compare and analyze sustainability-related financial information. But it could also benefit companies, the reporting companies, because by having this data provided in a digital format, it could also help companies to increase their global coverage by global investors. That could potentially result in increase for investment. In addition, more and more data collection and management systems are becoming compatible with digital reporting taxonomies, which could also improve process efficiencies in terms of companies' reporting process. Digital reporting can also help break language barriers. So the tags can have multiple labels in multiple languages, but still retain that unique ID. And this allows efficient and reliable translation to be done with a click of a button. And the last thing that I would like to highlight here in this module is a number of mechanisms that are in place in the standards to support preparers to get started with ISSB standards. So one simple thing that we put in place was to adopt well-known terminology and concepts that are familiar to preparers, borrowing from IASB concepts. For instance, many requirements in S1 and S2 are also to be applied proportionately, recognizing companies will have a range of capabilities and preparedness on these issues. There are also a number of reliefs for the first year of application, and these include companies being able to limit disclosures to climate in year 1, and then begin reporting on their sustainability in year 2. And companies being able to provide sustainability disclosures with their next half-year reporting, rather than at the same time as the financial statements in the first year of application. So again, going back to location, so this means that there is a transition relief for a company to be able to report on a later date in their first year of application to ease them towards their initial application of ISSB standards. Another relief that I would mention here is that companies could include information obtained from their value chain with a different reporting cycle in measuring their greenhouse gas emissions. And of course, we also have this a number of guidance and resources that we've already covered amply before. So that's location. So following that discussion, we'll move on to the second part, which is about ensuring efficient disclosures. And we added this to the training because a common comment we find from companies is that there is a growing reporting burden. But what we hope to highlight here is that when done correctly, efficiencies can be made to reduce that burden or perceived burden. First of all, it's really important to understand that what effective communication looks like and what is required. Often companies might think that if they just put all of the information that they have collected in a report, then it's all done. But this is actually against the core concepts, for instance, fair presentation. So it might be helpful to ask these questions when you provide your information and when you present them in a report. So for instance, is the information clear and concise?
And by clear, we mean clear could depend on the nature of the information. So for example, whether it could be clear perhaps to present information in tables, graphs, diagrams, plus the accompanying text. And is it concise? And to be concise, disclosures has to avoid boilerplate information. It does not need to have unnecessary duplication of information, and use of clear language is much preferred there. And ISSB standards are really designed to enhance this effectiveness and efficiency of companies' communication with their investors. And to that end, the standards require sustainability disclosures to be prepared with the same kind of rigor that is traditionally associated with a company's financial statements. And what this means is that, for example, the standards requires the disclosure of comparative information. It requires the restatement of prior period errors to ensure accuracy, avoid unnecessary duplication, cross-referencing only under certain conditions, and we'll talk about this more shortly. And again, coming back to this concept that information that is provided has to be material. It has to meet the principle of connected information and aggregated or disaggregated appropriately to provide information that is useful to investors. And again, these are all designed to ensure that your communication to your investors is effective and efficient. So let's talk more about cross-referencing. As you may have already noticed, there may appear to be some overlap in the topics that shall be addressed in disclosure. So for example, you might have some governance approach, you might have the same governance approach for all of your sustainability related risks and opportunities. So if that's the case, then rather than duplicate the information again and again, you can just use cross-referencing to enhance the efficiency of your disclosures, and your investors will thank you for doing that. So that's cross-referencing within sustainability disclosures. Another important aspect here is cross-referencing to other reports outside of the sustainability disclosures. So cross-referencing to other reports is permitted by the standards, but with conditions, and these are the conditions. So the cross-reference reports must be available on the same terms and at the same time as the sustainability disclosures. And this is because the cross-reference information is assumed to become a whole part of that reporting package, right? So you can't get away from the rigor of your sustainability disclosures that is required by cross-referencing to other reports. When you are cross-referencing to other reports, it is fine as long as you could ensure that the content of those other reports is available on the same terms as the rest of your sustainability disclosures. So for instance, it is fine to cross-reference to financial statements that has been prepared under the same terms. Cross-referencing shall also be done transparently, and it must not result in the information becoming more difficult to understand. And I think we have an example here. And
we're a little bit short on time, so we're going to skip the examples and the polls. And Tim, I'm going to challenge you to rush through the final bit of this training in the next 5 minutes, because we have closing remarks from Nadidi.
I shall do that.
Thanks.
Sorry about that. Thanks, Tiffany. I'll try to go through the remaining parts quickly. We don't have a lot more to cover here. So in the last part here, we'll look at investors' confidence, how we can ensure investors have confidence in the data that you're disclosing, as trust is an essential component of sustainability-related disclosures, and increasingly so. So I'll talk a little bit here about comparative, and then I'll try to wrap up quickly. So an important trust builder is showing data and trends over time. So here, the standards require the disclosure of comparative information. And just to demystify, what does it mean, comparatives?
So it is simply prior period information that is provided as a comparison to your current period information. So it is simply the previous year data that you provide as a comparison. That's what it is. Comparatives provides context. It helps investors to compare and analyze information, for example, metrics. And in this regard, metrics disclosed by a company might be redefined or replaced over time, or a company might change its method for estimating a metric. And in these situations, it is important for the company to revise the comparatives. And that is really to ensure that investors can compare and analyze your current period figures with the relevant prior period figures, because the objective is to enable that trend analysis, right? So you want relevant figures to be provided and hence the need to revise. And the same applies to errors. If there is material errors, then we ask you to restate those errors to enable that comparison. One thing that I would like to highlight here that it is important to remember that ISSB requires material information. So again, in that context, revisions or restatements are necessary only when there is a risk that material information being omitted, misstated, or obscured as a result of not revising or restating comparatives. And that is an important point to remember. And lastly here, a statement of compliance. It's important to build investor confidence, and one way to do that would be to provide a clear statement of compliance. So a company that complies with all requirements in ISSB standards is required to make an explicit statement of compliance. And this is, I think, a really good signal to build investors' confidence that your sustainability disclosures really meet that threshold of what is being expected of you by ISSB standards. And that is, I think, my last slide. Am I passing this back to you, Tiffany?
Thanks, Tim. Wow, bravo. Good job for getting us through that content. As a reminder to everyone, if you do need a refresher, if you want to come back to it, we have recorded this session. It will be on our website in the coming days. So that same website we've been sharing, the sseinitiative.org/JSE SAICA ISSB. So go back to that for your resources. We're going to skip our summary and our activity, but please do review that on your own time. It'll help you to do your homework. And I did put up the Menti already. If you can answer that last Menti question, we'd really appreciate it. And maybe Lois, you can share in the chat again how people can access the Menti. We really appreciate your feedback on that. And then just as we wrap up, a reminder, please make use of the resources we've mentioned. They're all in your slide handout, which is also on your webpage, or the webpage we've shared with you. That includes IFRS Knowledge Hub, that includes the standards themselves. Don't forget to download the standards. That also includes the IFC Beyond the Balance Sheet, which Raleigh shared with us at the beginning, and the SSE toolkit. So make use of all of those tools. Many people are also asking how to get your certificate. So we will share in the chat momentarily now a link for a feedback survey, and you will also get emailed that within 24 hours from Zoom. Fill in that feedback survey, and within a week, you'll have a certificate. And we now have 5 minutes to close. And Nadidi, you've been sitting here with us for this whole training and watching the Q&A and listening in and seeing the chat. I'm sure you have some important reflections to share. We really appreciate your leadership in South Africa and in the region, and I'm so pleased you're here with us. So I'll pass to you to wrap us up today. Thanks, Nadidi. Oh, we don't hear you, but you don't seem to be on mute. So I wonder if there's... Nope, still not. We'll just give Nadidi a moment here to be able to share her comments. And in the meantime, I'm going to share with everyone the link to the certificate. Here we go. We still don't hear you, Nadidi. Okay, let's give Nadidi just a minute to try to sort out her her technical side there. Just as a reminder to everyone, we do want to reward you for staying with us. really, really amazed with everyone who stayed with us for the full 3.5 hours. So congratulations to everyone. Pat on your back for that. Nadidi, I see you're now muted. Maybe that changed something, but we'll continue to the end and we'll come back to you when we can. I do want to thank our official supporters before we close today. Official supporters are stock exchanges and other organizations who have provided financial contribution to the UNSSE, and they make all of this training possible and also free of charge to all the participants. So thanks to all of those on our screen who are official supporters. And of course, this training would not have been brought to you without the support and the collaboration of our two amazing hosts today. We've had the Johannesburg Stock Exchange and SAICA, who have joined forces to bring this training to you all. And we very much appreciate them also for answering a lot of the questions in the Q&A. So thank you so much to not only the organizations, but also to Loshni and to Nomsa for sticking with us and answering all of those great questions. Now, before we wrap up, Nadidi, should we try one more time? Can we get your, oh, no, we still don't hear you. Well, thank you anyways for joining, Nadidi. Nadidi is, on the ground, pushing everybody, making sure that we're all moving in the right direction. And you're all working hard to make that happen. So thank you so much to everyone. Thanks to all of our presenters today. We had a full house of facilitators and a lot of help in the background answering questions. So thanks so much to Bella, to Tim, to Jarla, to Laura for bringing all that expertise of the IFRS Foundation. And thanks so much to Lois for facilitating as well today. Congratulations, everyone, for participating in the course today. We hope it was very informative, and we look forward to seeing the progress continuing in the country. Thanks, everyone. Wishing you a great afternoon. Take care, everyone.